Okay, great. Uh, Good afternoon, everyone. I'm going to call this public hearing of the Banking Committee to order this Tuesday, February 20th, 2024. My name is State Representative Jason Doucette. I am the House co-chair. We'll be chairing the hearing today. My co-chair, Senator Miller, is unable to join us today. She had a family emergency. She may be able to join us online on Zoom at some point, but she will not be here with us today. I'd next like to ask my ranking members if they'd like to have any comment before we get started. Representative Delnicki.
Good afternoon. I am Representative Tom Delnicki, ranking member here on banking, and I'm looking forward to a very interesting afternoon with the testimony we have before us. Thank you, Mr. Chair.
Thank you, Representative. Senator Berthel.
Good afternoon. Thank you, Mr. Chair. Good to see you all here. I am Senator Eric Berthel, ranking Senate Republican on the Banks Committee. I'm also the ranking Senate Republican on the Appropriations Committee. And I mention that only because I have to leave this public hearing to go participate in a screening meeting for appropriations, which those of you who understand the way things work here in Hartford will appreciate that. You want me to be in the screening meeting for appropriations. So with no disrespect to any of you who are testifying today, I assure you I will spend time later today or this evening listening to your testimony in favor of or against some of the bills that are on our public hearing agenda today. So thank you all for being here to testify, and I hope you have a good, productive meeting. Thank you, Mr. Chair.
Thank you, Senator. Yes, we know you're a busy man covering many committees, but you're an important part of ours, and we appreciate the time that you are able to spend with us. So I am normally required to remind everyone before we start the public hearing that in the interest of safety, I would ask you to note the location of and access to the exits in this hearing room. In the event of emergency, please walk quickly to the nearest exit. After exiting the room, proceed to the main stairs or follow the exit signs to one of the fire stairs. Please exit quickly from the building and follow any instructions from Capitol Police. So this is a hybrid hearing. We have some folks who are also testifying online as well, of course, in person, and perhaps even a combination of some folks who are testifying together who are going to do both. There is 3 minutes per speaker. Of course, the committee will have the ability to ask questions to extend that time, but we will be keeping time. Our clerk Hannah over there has a nice little timer with a buzzer or a beep to let us know. We have 23 people on our list today, and we normally most committees will reserve the first hour of the hearing for agencies and public officials. Today we just have one. We have representing the Department of Banking, Joe Chambers and Matt Smith, who are with us. So I'll call you guys up now to get us started today. Welcome, gentlemen.
Thank you, Chair. Thank you. The Department of Banking has 3 bills today. We're going to spend the majority of our time talking about House Bill 5140. We do offer written testimony and available to answer questions 45 and Senate Bill 122. Thank you very much, Chair Doucette, Ranking Member Delnicki, and honorable members of the Banking Committee. My name is Matt Smith, Director of Government Relations and Consumer Affairs for the Connecticut Department of Banking. Thank you for the opportunity to testify before you today to offer general comments on House Bill 5140, an act concerning earned wage access. This proposed bill contemplates changes to the Small Loan and Related Activities Act, specifically addressing earned wage advances. For decades, payday lenders have tried to do business here in Connecticut, attempting to circumvent our law with the introduction of various types of fees and variations on loan products offered. While the department has been successful in curtailing this activity, earned wage advances are just another iteration. The industry itself has been held to account by the courts and other regulators. Earnin recently settled a class action lawsuit brought against it by its consumers who incurred at least one overdraft fee or insufficient funds fee charged by a bank. The federal court ordered the federal court order approving the settlement required Earnin to provide $3 million in monetary relief to consumers and forgive $9.5 million. In addition, an earned wage access provider operating a direct consumer model similar to Earnin's was recently ordered to pay $18 million in refunds to resolve an enforcement action filed against it by the Federal Trade Commission for unfair and deceptive practices that harmed consumers. In an order dated November 8th, 2023, a federal court prohibited the provider from further misleading consumers about earned wage access cash advances and associated fees. The order also prohibits the provider from trapping consumers without providing a simple way to cancel and avoid fees. While the department would prefer to see no changes to the law, we appreciate the limited scope of the bill before the committee today. As such, it appears that the proponents of the bill agree that the proper regulation of these types of products is appropriate, especially given the above examples. This will ensure that Connecticut borrowers who use these products are afforded similar protections no matter the lender. Respectfully, the department would like to point out to the committee that even with the limited scope of the bill, some Connecticut borrowers may still be affected by its provisions. For instance, exempting employer-integrated products from a finance charge and subsequent annual percentage rate, APR calculation, in favor of a flat rate capped at $5 per transaction and an accompanying cap at $10 per month, resulting in borrowers paying APRs in the hundreds of percent. For example, a standard advance of $85 taken on the 6th day of a biweekly pay cycle with a fee of $5, the maximum allowed under this proposal, would result in an APR of 268%. That same transaction taken on the 10th day of the pay cycle would see the cost for the advance soar to 536%. Under the current law, these fees were capped at 36%. The calculation and disclosure of an APR for a loan and/or an extension of credit is the only objective measure a borrower has when considering the cost of money in the marketplace. The department appreciates the many conversations it has had with members of industry and with this committee and the legislature at large around this topic, and we are always available to continue the dialogue. Thank you very much, and I'm happy to answer any questions. Joe Chambers, our General Chief of Staff, our General Counsel and Chief of Staff, and I are here to answer any questions the committee might have.
Thank
Thank
you. And I forgot to mention, I was logging into the Zoom here. I see Carmine Costa, also from the department, is here as well, remotely. I assume just to answer questions, anything else that Mr. Chambers or Mr. Costa wanted to add at this time? I do have a few questions. I appreciate the dialogue that we've been able to have. This has been an issue, obviously, and I think most who have followed it know that has been under discussion for pretty intensely for the last few months. I do have a couple of questions that I think it would be helpful as we parse through this issue. So the department took a position recently with respect to one of the providers in this space and determined that they were not subject to our small loan law. I wanted to give you an opportunity to talk a little bit about that, what the distinction was with that provider, and the analysis that led to that determination, because I think it's instructive of what we're trying to do here in drawing a line and a distinction between the different types of models and products that are out there. So if you could discuss that a little bit.
Sure. Thank you, Representative Doucette. My name is Joseph Chambers. I'm General Counsel and Chief of Staff of the Department of Banking. Prior to joining the department 2 years ago, I was at the Office of the Attorney General. I was section chief. I was there at the office for 12 years. I was section chief of the Financial Services and Revenue section, and really had 7 client agencies, including the Department of Banking. Focused a lot of my time on multi-state consumer financial protection issues, investigations and enforcement cases. Very pleased to be here before the committee. I want to commend Representative Doucette and Senator Miller for the time that they've taken really to understand the issues around earned wage access advances. Specifically, I know you all have spent time studying the various business models. You know the distinction between employer integrated model and the direct to consumer model. And that the Department of Banking, we have too. After and even before we issued the guidance in September, we had significant dialogue with the industry, several companies operating in the space to learn about their nuanced business models. They're not all the same. They don't operate the same. And the department made the determination and provided a letter to a company called FlexWage, and in concluding that that company's activities fall outside of our Small Loan Act because they're really an earned wage access service that facilitates the early payment from the employer to the employee, rather than being an extension of credit or a loan from the provider directly to the employee. FlexWage, their motto really is that the company doesn't need to be licensed under the act, because although it partners with employers to assist those employers in providing earned wages to employees prior to the scheduled payday, the monies paid to employees before payday are always employer funded and are never paid by FlexWage. And they're never repaid by the employee to the employer or to FlexWage. It's truly they're getting their pay ahead. So we the department made the determination that these don't fall under the Small Loan Act.
So therefore, that particular company, FlexWage, and maybe there's others out there, and I don't, know all of the discussions that you've had with all the various, entities that have come before you. They don't have to register or be licensed in any way. Is that correct?
That's correct. They fall outside of the Small Loan Act and they don't require a license.
Okay. And under current law and under HB 5140, an employer integrated provider that operates slightly differently in that it may use its own funds to facilitate the advance to the employer would have to be licensed. Is that correct?
That's correct. That's
Okay.
the distinction.
And what is the distinction there? Why is that distinction being made?
Because the third party, not the employer, is providing the advance of monies and therefore falls under the statutory definition of small loan activity.
Okay. Yeah, we're making a carve out in a way in HB 5140 for those entities. So I guess my question to you would be, I think I know the answer to it, but does the department think it's appropriate still for those entities to be licensed, or is there is there some other sort of registration or something like that might be appropriate for those entities, given that they're still operating under that employer-employee relationship? It's just that the source of the funds is different than the FlexWage example that you provided. You still think it's appropriate that they be licensed as any other small loan lender?
Right. To reiterate the position, the department would like to see no change to the Small Loan Act. But if the committee and the legislature does go with the narrow changes that have been proposed in the bill, then yes, we think that licensure is required, should be still required. And there are, other important consumer protections within the statutes, the Small Loan Act, specifically 36A-558 contains a number of prohibitions and other requirements that protect consumers. And as you know, the department conducts regular supervisory examinations of our licensees to ensure safety and soundness and is concerned to ensure compliance with the banking law and other laws.
Okay.
So the answer would be yes.
Okay. And one last question on this, and then I'll turn it over to others. In terms of fees, now again, we have several models here. We have the flex wage example that you just cited. And then we have employer integrated, which I think we're discussing under, dealing with under HB 5140. Then we have direct to consumer model, all of which charge various fees. Is that correct?
That's correct.
So in the flex wage example, which is not regulated as a small loan lender, there are fees that can be assessed on the consumer or the employee. Is that correct? Or are they all paid for in that example of flex wage by the employer?
My understanding is that flex wage nationally has both. Most often the fee is paid for by the employer and not the employee. They did tell us that in some cases, the employer chooses to pass on the cost to the employee. Not my call to make, but there is a statute, 31-74, that addresses the circumstances under which an employer can, quote, make a discount or deduction from the wages of an employee if they're paid at an earlier time. So not my call. That statute's part of the Department of Labor.
Okay. All right. So I guess my concern would be as we're delineating between those different types of entities. And if our concern is trying to cap the fees, that we're doing it equally between the fully employer integrated, like you cited with flex wage, and other employer integrated models, which are going to be licensed under the current model. Do you follow my point? So if we're concerned about capping the fees, that we should be doing it equally among both types of entities.
Both types being direct to consumer and
No,
employer?
no.
No,
Employer
okay.
integrated like flex wage, like
Understood.
you cited, and employer integrated that's not like flex wage, where it's the funds are being advanced directly from the provider, not simply from the employer. That's what I'm struggling with. So
That may be more of a policy decision for the committee in terms of the flex wage model. My understanding, and please, Joe or Carmine, correct me. That model, which doesn't have, those companies don't have a direct interaction with the consumers, they're more interacting with the employer, is outside of the jurisdiction of the Department of Banking. So it would be difficult for us to opine on that because we don't consider those, because they're working directly with the employer, those aren't considered small loans. What we are concerned about are those transactions that fall within the small loan law. And we would probably try to restrict our comments to that, notwithstanding that there may be other laws in the Connecticut General Statute that may apply under those circumstances with flex wage that we don't have experience
Understood.
with or are subject to the jurisdiction
Understood.
of the
Okay,
department.
so last question. I know I said last, but this is last question. One thing that's missing from 5140 currently is an express carve out for the flex wage type providers. Do you think it would be helpful for us to have that scenario dealt with in the Small Loan Act to make it clear that that scenario does not have to be licensed under the Small Loan Act?
I think clarity is always a positive. We've publicly discussed the conclusion that the department made about flex wage. We've contemplated putting out additional industry guidance to that effect. reading through the testimony submitted to the committee, I wonder whether some of those industry representatives who submitted testimony wouldn't have benefited from a conversation with the department about whether they fall under the Small Loan Act or not. But we invite that kind of dialogue. And after we delve into the details of the business model, you know, it could be that some of the providers that are opposing the bill, you know, may not even be subject to it under the department's analysis.
All right, thank you. Others, Representative Delnicki.
Thank you, Mr. Chair. And thank you to the banking department being here, Matt. Can we just circle back for a minute? Because you went through how we got here very quickly. And I'd like a little more detail of how we got here, the lawsuit, et cetera, so that we have a full grasp of why we're here.
Sure, I can provide a lot of detail, and I propose to go back a long way,
Okay,
back to the 1920s, where the Small Loan Act originated. So the department has a long history of combating high interest loans and unlicensed loan activity in Connecticut. Our main tool is the Small Loan and Related Activities Act. The legislature intended the act to be broad in scope, remedial in nature, and protective of consumers. The act dates from the 1920s and for decades has allowed small loan lenders licensed by the department to exceed Connecticut's 12% criminal usury limit. If they follow statutory requirements, the act allows licensed small loan lenders to impose finance charges resulting in APRs up to a 36% cap. If lenders stay below the 12% criminal usury limit, they need not be licensed by the department to operate in Connecticut. I want to read a quote from the Connecticut Supreme Court from a decision dating from 1932, in which the court opined on the purpose of the Small Loan Act, which is, quote, to furnish an opportunity for borrowing to persons of small means who might be in need of money and unable to obtain it to relieve their necessities at ordinary commercial rates. Provisions of the act indicate care and foresight on behalf of the legislature. We may fairly assume legislative recognition that loaning money at a rate of interest greatly in excess of the legal rate permitted called for strict limitations upon the lender and for measures of protection to the borrower who is forced to make such agreements by the necessities of the situation. So the Small Loan Act in the decades since has been a broad and remedial piece of legislation that has applied to many different types of small loans and lenders, including payday lenders, rent-to-bank schemes, tribal affiliated lending schemes, buy now, pay later loans, and other new online forms of lending, such as fintech small loan apps. In 2016, the legislature amended the act by passing a bill that became Public Act 16-65. The 2016 Public Act significantly expanded the scope of activities requiring licensure for small loan lending, expressly including advances of money. So 36A-555 provides the statutory definition. Now, many of the industry representatives providing written testimony to the committee continue to parrot the bogus argument that so-called earned wage access advances are not loans. Many also imply that such advances are not covered by the Small Loan Act. Some cite opinions interpreting laws in other states for support that because such advances are not loans in those states, they are not loans in Connecticut. None, however, discuss the actual statutory definition within Connecticut's Act. In fact, one of the written testimony provided by one of the earned wage access providers even goes so far as to tell the committee in writing that Connecticut law does not statutorily, quote, Connecticut law does not statutorily define the term loan under the Act. The argument that advances of money are not covered by Connecticut Act is easily refuted by examining the language of the statute itself. 36A-55512 defines small loan to mean, quote, any loan of money or extension of credit or the purchase of or an advance of money on a borrower's future potential source of money, including but not limited to future pay, salary, pension income, or tax refund. That's the setting since in 2016. Fast forward to 2023, the department, the Consumer Credit Division, Carmine Costa, our colleague, is participating via Zoom today. His division within the department conducted an investigation of small loan lenders that were purporting to collect only tips. And their investigation revealed that the tips were not actually voluntary. The company, called Solo, required most borrowers to pay the so-called tips or else they did not receive the loan. In other words, it was under our statutory definition, it was a condition of credit. The commissioner issued a consent order against Solo on May 16th, 2023. And in our press release, we referenced SB 1033, which contained the department's proposed changes to the act that were then part of Public Act 23-16. And it expanded what the act deems to be finance charges for purposes of calculating the APR. So charges for other products, membership fees, subscription fees, concurrent with that small loan, any amount offered or agreed to by a borrower in furtherance of obtaining credit, any fee, voluntary or otherwise charged. So it was really through that investigation that the department realized that we needed to change to how finance charges, what was included in the finance charge to prevent small loan lenders. And at the time, it wasn't earned wage access. It was a small loan lender not purporting to be making extensions of credit or making cash advances for earned wage access. But that's what led to the department to propose those changes.
What triggered the investigation? Because you made mention of an investigation occurred.
Yeah.
Was there
Carmine
a
may be
trigger
able
to
to answer that. I think it may have been a consumer complaint or,
Typically, our investigations are precipitated by receipt of consumer complaints, sometimes whistleblowers.
And in your opinion, we're talking about a number of different types of ways that these loans, advances, et cetera, work. How many categories are we dealing with here? And what are the nuances pertaining to that? And how should that be dealt with?
Is your question focused on earned wage access or the Small Loan Act broadly?
Well, there's a number of different products.
Hmm.
And each one has a nuance to it.
Understood. And I think what's important to know is that the statute is written broadly because it's difficult to the department to anticipate any new products that may emerge into the marketplace. It is not, it is fairly routine and not uncommon that when companies are interested in moving into the Connecticut marketplace to reach out to the department to see if their business model requires licensure. Since 2016, when advances of pay and future income became part of the very definition of what a small loan is, companies have had 8 years now to see if their model, regardless of whether or not they're including tipping, fits into the definition of a small loan. So I think we write it broadly and then we leave it up to companies in consultation with their counsel to see if their activity requires licensure. And we're always available to help companies who may have questions about that.
And I asked that question based on some of the research I've done. and noting the different ways that the different models work. Some totally voluntary and some that are not necessarily totally voluntary. Some that are actually employer sponsored and some are actually offered to consumers as a opportunity.
Correct. And the way this is set up is, so whether the fee that's being charged is voluntary or whether it's just a flat fee as part of the service, those should be incorporated into an APR calculation that should be disclosed to the consumer because, as I stated in my testimony, it is the only objective measure a consumer has to compare the cost of money on different products in the marketplace. It's a fair, reasonable, and the most universally understood by consumers, what that money is going to cost them, regardless of any flat fee that may be associated. That may seem small at the time, but the impact can be significant to the consumer.
Well, thank you for your testimony and answers to the cornucopia of questions here. Thank you, Mr. Chair.
Representative Delnicki.
Thank you. Representative Foster.
Thank you so much. I was a few minutes late because I was coming from another committee meeting, so I apologize if this has been already asked. I have a couple of questions, and this is coming from a place of genuine curiosity. This is a novel topic for me and novel for my constituent base to be engaged in and talking on. Last year and this year, I've received a lot of constituent emails from people really concerned that this tool is helpful for them to make ends meet when unexpected bills come up. And I have in my district several emails that have sort of come up about this. And so I would like to just understand if what is the definition of what qualifies as a loan and how do the ones that you believe differentiated, you had mentioned at the end of Chair Doucette's comments that some of these you think might not qualify under this provision. They might not have the same applications that people are concerned about applied to them. So I'd really like to understand what is differentiating them and what you don't have to name specific companies, but what companies under what considerations could come to the Department of Banking and say, does this apply to us? And you would say no.
Okay. So I'm going to start off pretty basic. There are basically two models: a direct-to-consumer model and an employer-integrated model. The employer-integrated model has a couple of different variations. What we had talked about with Representative Doucette was a specific company called FlexWage, who, correct me if I'm wrong, Joe, but I think you might say it acts a little bit more as an administrator for the employer in dealing with advances of income and advances of pay. And as such, with no interaction with the consumer, it falls outside of our small loan law. FlexWage, the company that we issued a letter to saying that, they did not require licensure under our small loan law. Oh geez, now I just lost my my train of thought. So FlexWage works with the employer, does not front any money directly to the consumer. Other employer integrated model. Now, the choice in that model, before I go on to the other one, as to whether or not an employee is going to pay for that advance falls to the employer. They can either absorb the cost or they can pass the cost onto their employer, onto their employee, right? Sort of independent of the company that is administering this type of product. Another employer integrated model that uses verified wages. They actually verify that the consumer works there. They've worked, 4 days. They're entitled to X amount of dollars based on that 4 days. They would front the money and charge the consumer. So that acts a little bit differently. And because they are fronting the money and charging the consumer should be it is the department's belief, and under current law as it stands, is now required to disclose to the consumer what the cost of that money is. When even on what are seemingly nominal fees of $2, $3, $4, $5 as the maximum allowed should this proposal move forward, results in an APR calculation in the multiple hundreds of percent, depending on when somebody may be looking for advance in a biweekly pay cycle, right? So the APR is basically calculated with, it takes into account any interest that's being charged, any other flat fees. It's divided by the principal. So if you have an $85 and you have no interest, but you have a $5 fee, would be like $5 divided by $85. You're then dividing that by the number of days and multiplying it. There are some other multiple factors that come up with a percentage. And when you do that calculation, the APR comes out in excess of a 36% cap under our Small Loan and Related Activities Act, which is the maximum allowed under that law. The direct-to-consumer model, which is the third model, does not have an employee verification. They're generally verified by direct deposits into somebody's account. You're like, okay, yeah, they're getting, every 2 weeks, this company is depositing to their account. We know that they're employed. And then they debit, they'll issue an advance and then debit the bank account directly. Now, I don't know if that answers your question, but it gives you a little bit of background. Can you repeat exactly what you want answered?
So did you say the first example would get a letter saying that they do not qualify? That's what you
Yes,
said?
and that's
But
what
the
we
latter
did.
two do not. Is that what you're saying?
Correct.
Okay, my understanding of the Small Loan Act is that it's intended to protect the consumer from predatory loans.
Correct.
And if you have a percent of interest that is calculated on a system that is incongruent with the traditional APR system, and then therefore the number looks artificially inflated. I know technically the math is correct and it is lining up, but the products are different. And so the way the math is working and applying to the system, the APR looks artificially larger than a traditional loan product. It might have the inverse effect, correct? Like it might make someone think, oh my God, this is super dangerous, when that might not be the case for the consumer.
Well, I think as long as you use the same calculation, and that's what makes this an objective measure, is that it's the same calculation that's used to determine the APR, no matter the loan.
Well, yeah, but you could, so I have great pause with that, because you could apply the same calculation to an inappropriate system. And if it's not, you're applying the same, the same equation between apples and oranges. You're not going to get the same metric. I can apply the same calorie calculation for calculating calorie needs for me as an adult and use the same calorie calculation for a child. And technically it's the same, but you will starve a child. If you use the same calculation using a fair metric, it wouldn't be the same. So I think APR, like if you're comparing apples to apples metrics, intellectually, and I don't mean this to be combative, I'm like actually frustrated as that I don't understand what you're saying. If the whole goal of APR is to help someone know, I'm going to be underwater, the interest rate on this is so high, it's going to take me forever to pay back, and in the end, I'm going to pay so much more than the front that I needed in the meantime. That if that calculation says some astronomical percent, but in the end, they're not actually paying back a tremendous ratio larger than the product that they were borrowing, it is artificially telling them that it is an unsafe or I don't know if I'm articulating myself clearly enough, but it seems okay.
Understand the question, understand the concern. I think what might help is to understand, as I saw the written testimony of someone else who's going to testify later, but an average consumer uses these products 36 times a year. So when you think like, okay, it's only $5, similar, you'll hear from the industry, it's similar to an ATM fee, which that's your money you're accessing. This is credit, it's different. But it's when you're accessing this product 36 times a year, those APRs become relevant because those fees add up and it impacts consumers. So the impact on the consumer is really no different than a longer term loan when you calculate out the APR. So you could have a consumer say, borrow $100 10 times or borrow $1,000 once, the impact on the cost of that credit to the consumer is the same regardless of when you calculate out the APR. So, and when you know that a consumer uses a product 36 times a year, there's a real impact.
But in the example you just gave, wouldn't the math work out differently? So if they borrowed a small amount multiple times, they would pay more fees and the APR would be inflated by that math, right? Or am I not understanding? You didn't finish how the APR calculation works, so I
Yeah,
didn't.
I don't know if it would be inflated, but you would have a greater APR.
Yeah. 'Cause the
So you
shorter-
can buy, you can get $1,000 loan and say, you're paying, 17% on it or whatever from Lending Tree or whatever.
Mhm.
If you were to do that over the course of a year, you would pay a significant more interest, which we call interest or fee or APR, an
Mhm.
annual percentage rate, than you would if you were just to take $1,000 out and pay, the 17%.
So I apologize if this is like an excessive ask, but it would be super helpful to me is if you could set up like an Excel column and show me like the average high interest APR and how that worked out. And then give me a side-by-side comparison of what it would look like if you did 36 loans. Like, so I could see the math as it actually works out. Like, what is the person paying in the end difference? But like, give it to me with a live Excel so I can see the equation and know that the math works. That would be super helpful to me because that would I would read it and then be like, okay, I get it, done.
We'd
right?
be happy to
That would be
provide
super.
that.
Thank you
And
so
I-
much.
And I think the beginning of your question, spoke to consumers.
Mhm.
And that consumers have come to rely, for better or worse, on some of these products.
Mhm.
And, the law doesn't prohibit earned wage access advance. It only requires that the companies that are providing these advances comply with our small loan act. And we talked today about a number of ways that if they structure their business model and structure their finance charges, that they'll continue to be able to provide access to Connecticut's consumers.
And I appreciate that important distinction because I think oftentimes when customers, and this is the last committee I was in energy policy versus here, when customers testify about bills on behalf of a company that's saying like, hey, you wouldn't have access to this product you use. A lot of times they don't really know what the impact would be directly to them, like when we talk to a company directly or to an advocacy agency. And I think a lot of times maybe they're more worried than the technical implications of the bill. So I appreciate that distinction and thank you very much. Sorry for direct questions.
Thank you, Representative. No, it gets a little convoluted sometimes. You guys had provided at one point to me a one-pager that broke down the three models like you just outlined. That might be helpful if you could send that to our committee clerk, Ms. Clark,
We can do that.
Ms. Hayes, that we could distribute that. It might clear things up for folks. Anyone else? Nope. Okay. With that,
Thank you.
thank you for your testimony.
We will be here if you need it, if you need us to answer any other questions. Thank you.
All right. Next on my list, I have Matt Pierce from Immediate.
Good afternoon.
Oh, there's Matt. Matt's online.
I'm
Good.
remote.
Thank you.
Thank you, Chair Doucette and members of the Banking Committee for the opportunity to speak today. My name is Matt Pierce, and I'm the founder and CEO of Immediate. Immediate's a financial wellness and employer integrated earned wage access company. And we appreciate the committee's goal of increasing safeguards for the people of Connecticut, making the distinction between the employer integrated model and others in House Bill 5140, which you all have just been discussing. We offer comments to HB 5140 to allow the workers of Connecticut to fully experience the benefits of access to their earned wages. We started Immediate with a mission to combat predatory lending. As this body understands, high interest credit and cash advances leave workers deeper in debt to address short-term needs. And that makes regulation of this industry imperative. The concept of responsible employer integrated earned wage access is a system designed to contract with employers as an extension of their payroll to allow employees access to their earned but unpaid wages. We do this through connecting to existing time tracking and payroll systems. And based on this model, we respectfully disagree with labeling EWA as a loan in the state of Connecticut. Immediate has customizable guardrails And we set these in partnership and coordination with an employer. We do this to provide access while also protecting the employee's overall paycheck and broadly aligning with what you've established in HB 5140. However, based on our average users' utilization of 5 transfers a month, the current caps would restrict access when a Connecticut resident may need it the most. Now, here's the important part that we like to point out is that we survey our user community very regularly. And through these surveys, we found that utilizing earned wage access results in 89% of our users avoiding unnecessary debt or leveraging earned wage access instead of overdrafting an account. And those same surveys have reported that 85% of this usage is for needs-based items. It's typically things when the payday doesn't match up with bill due date. And so they're using it for paying bills, putting groceries on their table and in their cabinets, transportation to and from work, and housing. So our request here is that we can have the opportunity to continue to collaborate with the committee on an updated framework that to regulate employer integrated EWA. Thank you again for hearing our industry's voice and the changes that have been made so far and the consideration that you've already gone into this bill. We look forward to continued collaboration, and I'm happy to answer any questions while I'm here.
Thank you, Matt. Appreciate your testimony. So,
Absolutely.
as you said, you are an employer integrated provider. However, you would be within the group that would be required to be licensed under current law and under 5140. Is that correct?
That's correct. And while we do offer every one of our employers the opportunity to pay these fees on behalf of their employees, we have very few who do.
So you may have heard my question earlier to the representatives from the Department of Banking. Recognizing that you are an employer integrated model, do you have any suggestions, or is there anything short of licensure that you would suggest we would implement to make 5140 better for you?
I think the big thing that we'd like to focus on here is the caps that you all are putting in place. As I shared, when we rolled this out to our employers, we allow those employers to adjust the caps and guardrails. We have very few of our employer partners who allow uncapped transactions, meaning the total number of transactions. Most of our employers will put caps of 2 to 4 transactions per pay period, and they recognize that these are smaller ticket items. I heard one of the comments earlier was that an average transaction is about $85. That's not the case for us. Our average transaction, looking at all of 2023's data, was $137. And as I mentioned, a lot of the time that's to go towards these needs-based items like paying bills. And so a lot of it for us is when we look at what's been established or put out here of the cap of $5 per transaction and $10 per month. I think that's gonna put us in a position where a lot of the Connecticut residents simply won't be able to use this as frequently as they need. And to the point earlier, if it's a flat rate, we're open to discussions on what that flat rate needs to look like. We're open to discussions on if there needs to be a cap, but we feel like the $5 per transaction and $10 per month is too low.
Okay, so what would you say is the average of transactions per pay period for your consumers who are your employees who are involved?
So it grew from the beginning of last year to the end of the year. I think a lot of that has to do with the economic times we're living in. If we were talking February 20th of 2023, I'd tell you our average user makes 1 transaction a week. Now that number's up to 5.1 per month. So we're looking at like 1.25 per week, right? And that's average and annualized. So when we look at that, again, the numbers have gone up a little bit over the past year. We also have, we as an organization, and I think some of the others you'll hear from today, offer multiple transaction types. We offer free transactions. We offer free transactions to gift cards. We offer free next day transactions to a bank account. So if someone's planning ahead, right, they're not in a situation where they need the money right then, they can plan ahead, make transfers into a bank account. And we also offer an immediate debit card where people can make free transfers there. And so that blend of what we're seeing is 5 transactions a month. It's blended across some of those $3 fees that I need the money now. I'm at a gas station. I need to put gas in my tank in order to get to work. And others are I'm planning ahead and I'm purchasing a gift card that's free that I'm going to use this weekend to take my wife out to dinner.
Yeah, I'm glad you mentioned that. I think that's important because you know, it's not the only option. So if we
Right.
did, you know, continue to have a cap in the legislation, that there would be other options for people to access those funds in other ways. So, you know, I'm just a little bit wary, you know, when we talk about an average of 5 per month, that, you know, or in some cases a lot more, that, you know, there's a lot of fees involved. So
Sure.
that's helpful. But again, my earlier question was about licensure. I'm interested to hear from your perspective, and I'll probably ask this to others who testify, what you know, what you're doing. And I don't know how many states you operate in. I know there are some other models where they have a registration in some states. You know, what do you think in a perfect world, as we're working through this legislation, would be the appropriate type of licensure registration for your company or and others like you to do?
We operate in all 50 states. We're licensed in Missouri and in Nevada, who have both, we've gone through similar processes there. We're open to that licensure based off of what those regulations entail. And for those, we went through the process. I think the big thing that we're trying to avoid here is to be viewed and labeled as a lender. I started this company 6 years ago, and from before we wrote the first line of code, we spent a lot of time and effort and energy in ensuring that we wouldn't be lumped in as lenders, because we're trying to compete against what those predatory lenders are doing out there. And so when you lump us in with those, which we've seen some other states bring up legislation that starts to go down that path as well, we've done our best to say we want to ensure that we're not being viewed as a lender, but we're always open to sharing data as it sees, as I just shared with you all. And I think you'll probably hear some of the same from some of the companies that we compete with day in and day out. But you can see here today that we're kind of coming in arm in arm. So we're open to licensure. I think it all comes down to what is expected of that, and some of the data that we can provide with you to ensure that we're operating in your state in a fashion that you see fit, but also in one that's good for our business for the long run.
Right. Okay. So, I mean, I think it's a nuanced thing, because you said you're open to licensure, and, you know, this bill and current law requires licensure. But more importantly, this bill is sort of creating a carve out for companies like yours. So, you know, I think it's sort of the same place we're getting to. But I appreciate your comments. Anyone else? Representative Delnicki.
Thank you, Mr. Chair. Just so I'm clear here, this is employer sponsored, so it's a function of a benefit to the employee. Is that how you couch the issue?
That's correct. So we offer our platform as a voluntary financial wellness benefit can be rolled out during open enrollment, can be rolled out anytime during the year. And the employees then can opt in to download the app, install, and start using that. We typically see, you know, it varies from industry to industry, but we typically see between 20 and 30% enrollment. And then we'll usually see anywhere from 50 to 75% of those users that will access it at least once a month.
And the only time fees kick in, can you just recount that?
So for us, Immediate, we offer, there is no fee for them to download or activate. We do have financial wellness materials that they can leverage free of charge inside the app. They're only going to pay a fee when they make a transfer to an external account, so their own bank account or a bank issued debit card, Visa or MasterCard. And there's a flat rate for us, a flat rate $3 transaction fee that they pay in order to do that. They can make free transfers to an Immediate debit card, to a gift card, and then they can make next day transfers if they're planning ahead. They can make next day transfers into a bank account through ACH for free.
So you provide a way for employees not to have any charge, any fees, any transaction fees.
That's correct. And we do that. And obviously as just from a business perspective, where we generate revenue there is from MasterCard or Visa and interchange. But we do offer those as just another option.
So as long as an employee takes that course, there won't be any charges to the employee or the employer?
That is correct. We have some users who who log in once a month and make transfers into a gift card, or they go in and they're planning ahead and make a transfer into a bank account for tomorrow. And with that, there will be no charge that comes along with that.
So they could transfer money into a bank account and then take that bank account and transfer that into a checking account and then totally avoid fees. Is that reasonable comment on my part?
If they're planning ahead, they could transfer that directly into their bank account that they use every day. So assume they use a Chase account, they can plan ahead and transfer money directly into their account the next day. What we typically find though is that people are this is a reactive model, right? There's not as much proactivity to it. You don't plan to be in a difficult financial position, and so when you find yourself in those positions, just because of the fact that we have back end costs that are associated with transferring funds quickly, there's that $3 fee that comes if they want to move money directly into their bank account at that time, or directly onto a bank issued debit card.
And they're fully made aware of the situation there, because I can understand a situation where somebody is getting dunned every time they get a charge and making a transfer. Then it becomes a self-defeating enterprise.
To your point, it's a very transparent model. Every time there's a double prompt before they transfer money, where it shows them what the fee is going to be. It shows them when the money will be, when it'll come out of their following paycheck as a deduction. And to your point, we work with employers if they want to set caps and guardrails where it makes the most sense to them. Then we can allow that. Some of our employer partners only allow 1 or 2 transfers per pay period, and so we do allow the employer to participate in that as well.
So you actually can custom tailor the product
That's
to
right.
desire of any employer that wanted to protect their employees.
That's correct.
Well, thank you for your testimony. Appreciate
Absolutely.
it.
Thank you.
Thank you, Mr. Chair.
Thank you, Representative. Anyone else? Anyone else? Okay. Appears not. Matt, thank you for your testimony today.
Absolutely. Thank you for having me.
All right, next up is Charles Bell from Consumer Reports. I have him testify remotely. And I don't see him online. Is he online? No? Okay. Then next would be Kevin Lofton from WageStream. Hi, Kevin. Welcome.
Thank you.
Thanks for
Appreciate your
joining
time.
us.
My name is Kevin Lefton, and I'm the head of U.S. Legal and Regulatory Affairs for WageStream, an employer integrated earned wage access provider, similar to many of the other providers you'll hear from today. I'd like to thank the chair and the committee for working on this important issue and realizing the important distinction between direct-to-consumer and employer integrated earned wage access services, and further for having an open dialogue about the benefits of earned wage access to employees and employers. Like many other providers in this space, we are supportive of regulation that helps protect consumers. And like so many other earned wage access providers, we oppose payday loans and other predatory financial products. However, it is critical to understand that earned wage access services are not credit and are not a loan and should not be viewed or regulated as such. Employer integrated earned wage access services are critical to many users, many of whom are in the hospitality, manufacturing, healthcare, and education industries, and many other important industries that have hourly and frontline workers. The benefit to users of employer integrated earned wage access services are that they're paid for wages they've already earned, not future wages, when they need it, and have a low or no cost option, which is an alternative to a high cost payday loan or excessive overdraft charges that many consumers face without this service. With employer integrated earned wage access services, the benefit to employers is that the employer has an easier time filling shifts when workers know that they can be paid the same or the next day. And studies have shown that it's easier to attract and retain new talent when earned wage access is offered as a benefit. To really understand the difference between employer integrated earned wage access and direct to consumer, it's critical to understand how the service works. For employer integrated earned wage access, the employer, such as WageStream, enters into a contract with the employer. This allows the earned wage access provider to obtain accurate employee time and attendance data We're not estimating wages. We see actual data. Second, unlike credit or loan products, earned wage access services are provided at either low or no cost. Low cost would typically be an ATM fee charge or less. Providers do not charge interest. Providers do not pull credit reports on the user. The service is not based on creditworthiness. The service is non-recourse to the user, and there are no reports to collections or creditors at any time. Earned wage access services are an excellent financial tool for employees and a great benefit for employers to offer, and should not be limited by fee caps that would limit the employee's use of this product. This service should not be considered credit or a loan because earned wage access services are based on wages that have already been earned and do not share any of the same characteristics as a loan. Thank you for your time, and I'd be happy to answer any questions.
Thank you. Appreciate you joining us. You heard my question to the last gentleman. Same question. Sounds like your business model is relatively similar.
It is.
What changes would you like to see, recognizing that there's sort of a carve out?
Sure.
Sounds like generally for companies like yours in terms of the licensure aspect and in terms of the transaction cap
Sure.
aspect.
First of all, I appreciate the question. I think this is an important one. I come from the money transmitter world before this, where there was a license for money transmission. And I think a similar path should be taken. I think we should stop trying to fit a square peg into a round hole. I think there should be a license for earned wage access or a registration. Missouri has a registration. Nevada has a license specifically for earned wage access. And so to answer your question, I think that's the path that should be taken. To Representative Foster's points, I think her points are very well taken, and some time and consideration should be spent on some of the things that she said. I think trying to applying an APR concept to this is misleading, because this is a service that users love. Okay. And it is disingenuous to tell them it's going to be a 200, 300% APR when really it's either a $3 flat fee for the $85 example that was provided, or it's free for the next day. And so, and also it's not a loan, so an APR shouldn't be applied. Okay.
But aren't you in a way extending credit still by the fact that your company is using its capital to facilitate this transaction, as opposed to the other example we heard about where all of the funds are within the employer's accounts
Sure.
and payroll
Well, I think you'd
accounts?
have to look, my answer to that would be no. I think you'd have to look at the definitions of loan and credit, which typically involve interest. They typically involve an obligation to pay back. And in most of our models, at least with WageStream, if you don't pay back, if we provide you with the funds and you don't pay us back for that transaction, we just shut you off. There's no recourse. We don't come after you. We don't send you to collections. Okay? As Representative Foster was saying, this is a different product. We should not be trying to fit this into the loan or credit application. Okay, this is just something new, and I think it should really be viewed as such.
Yeah, I understand, but I also tend to agree with the department that if we get too far afield, trying to reclassify things, I think we run the danger of really kind of missing the forest from the trees. So with respect, and we don't, and we've got a lot of other speakers here. I think there's lots of different ways that you could attempt to classify a loan and aspects of a loan, but I'm not sure that's the analysis. And as the representatives from the department said, we do have a clear definition in statute already. So I don't want to relitigate that issue, and that's not the intent of this legislation. The intent of this legislation is to try to provide a narrow carve out in cases where it may be less like a loan than some other types of products. But Representative Delnick.
Thank you, Mr. Chair. You made a comment, if somebody didn't pay it back, in essence, you just don't go after them. You don't assess any collection agent or what have you, correct?
Correct.
Do you report that
Nope.
deficiency to the credit bureau
No.
or any credit bureau?
Absolutely not.
So in essence, somebody would, if they defaulted, didn't pay it, you would not notify the credit bureau or any credit bureau so that it would not show up on their credit report.
Absolutely not.
Okay. Thank you, Mr. Chair.
Anybody else? No? Okay. Well, Kevin, appreciate you joining us.
Thank you
Thank
for your
you.
time.
All right, next on my list is Phil Goldfeder. Goldfeder. Thanks, Phil.
Thank you, and you'll excuse me, I'm still sort of figuring out whether I should read prepared testimony or try to hold back some of the comments I want to make based on what I've heard already.
Well, yeah, did you submit prepared
Yes, sir.
testimony? Then great, then I think it would be better to just speak to us, have a conversation.
So, and I appreciate that, and I think that's what I'll do, and again, I appreciate your time, and I hope Chair Miller is okay and everything is okay with her family, and so thank you, Representative Doucette. I mean, the challenge here is that we continue to try, again, and it was said earlier, is fit a square peg into a round hole. And we're trying to take what is a nuanced product. And I appreciate the comments you literally just said, right? Sometimes we don't want to continue to overdo it. The American FinTech Council is an organization that represents multiple business models, multiple companies, all servicing consumers in a different way. I tell you that I served in the state legislature in New York. Don't hold that against me. And I can tell you that oftentimes when you listen to certain agencies speak about the nuances of the law, it's about the nuances of the law. Historically, agencies are tasked with taking a look at the historical law and finding the exact way to fit sort of the current process into it. Sometimes you actually lose the consumer, right? And I think that's ultimately what the legislature is here to do, is to look at the nuances and make those adjustments as necessary. You know, we talk about things like about APRs. When you listen to sort of the agency talk to Rep. Foster and explain how to calculate it, and then accept that consumers understand how to calculate it or how it's going to impact them, we're doing ourselves a disservice. And we think about comparing one product to, well, we're going to use this one 36 times. Well, what if I were to go to an ATM machine and take out an ATM and get charged $5.99 36 times? We're not on a $20 withdrawal. We're not going to look at it the same way, because it's not, you're not looking at it APR to APR. It's not an APR. It's a different product altogether. And so I understand the nuances of the law and protecting consumers, but ultimately we have to recognize, are we doing today what is in the best interest of consumers? And I think that every single company that we represent sort of works within a standard, whether they're direct to consumer, whether they're business integrated, they're servicing a different customer that can't access another product or doesn't want to access another product. Ultimately, consumers who are using earned wage access are not looking for a loan. This is an alternative to a loan. If a consumer wanted a loan, as you know, plenty of places for them to get it. Some of our members are online consumer lenders who are lending responsibly. They can get it there. They can go to a credit card. There are many options for a loan. They can go to predatory lenders. They're using these products because it is a safe, viable alternative option to a loan. And ultimately, it's the reason why they continue to use it, because it's a better product and it serves their needs better.
Thank you. Appreciate it. So to clarify, your American FinTech Council, I probably should have let you do a little intro.
Yeah, sorry about that.
Represents all types of fintechs, some who operate in the space and some who are both direct to consumer and employer integrated. Is that correct?
Correct.
Okay, good. Anyone? Rep. Del-
Thank you, Mr. Chair. Just the previous person that testified, when I asked the question pertaining to reporting deficiencies to collection agencies, to the credit bureau, et cetera, would that be something that we should include in this legislation so as to guarantee some protection to a consumer?
Again, it's sort of, if you're looking at it in the characteristics of a loan, and the challenge with this product is that we're not basing price. You're not charging based on risk, right? And so it's
Right.
got no characteristics of the loan, in which case on the back end, if a consumer doesn't pay, every company would inevitably shut off that consumer and not let them take another one. You'd be hard pressed to change the back end without sort of changing the system on the front end. Ultimately, again, the consumer is using these products specifically to avoid those things. They could take another credit card, right? Credit cards, you know, while I would challenge most people don't know what they're paying APR on their credit card today. I know I can't tell you what I'm paying on my credit card today. And yet we continue to use that as the determination for what is right and what is not. And I think ultimately the consumer is the one who's losing out by prohibiting this service in Connecticut.
But could one of these EWAs possibly report to the credit bureau or to a credit bureau if they had a situation where somebody was basically had failed to live up to their obligations?
Again, they don't, because it's not a loan, right? These are not, these are wages that have already been earned, right? They're not advancing anything. And I think, the other thing I think it's important to note is, we get into the semantics of which pocket is the money coming out of, right? Oh, it's coming from this one and this company is just a servicer. We're really at that point, we're not looking to protect the consumer. We're looking to protect the letter of the law. And that's not really what we should be doing is sort of as state regulators. Is the idea as to how do we best protect the consumers given the construct of the new product. And yet the idea that, well, I'm going to come up with it. I mean, we're essentially forcing people into how do I get around it? Right.
Mhm.
And that's not what we should be doing. The department, and to their credit, has met with many providers. We've spoken to them a number of times, and I give them credit for that. But ultimately, the concept of we're going to look for loopholes to avoid the nuances of the law is not the way responsible innovators want to operate. They want to come at you and say, here's what we want to do. Let's find the structure to make it work.
Well, I only ask that question because Canton don't mean two distinctly different things. Thank you, Mr. Chair.
Anyone else? I do have one question though. You mentioned perhaps illustrating your point, but perhaps not, that you don't understand the APR on your credit card. Does that mean you believe that that we shouldn't have an APR disclosed for credit cards?
Oh, no. So let me just say, it's not that I don't understand it. I understand it quite well. I just don't know what it is. Meaning, historically, you go to a department store and they tell you at the counter, do you want to save 15% today by signing up for a credit card, right? We've all been through that. I guarantee you, no one at the time when they fill out that trifold knows what the terms are, when they're going to have to pay back, what compounding interest is, what the APRs are, and so on and so forth. And so I would tell you that I'm holding 2 credit cards on me today. I don't carry more than 2. And I don't know if I were late or on a payment, if I carried interest month to month, what the actual APR is. I would argue that most consumers are the same.
Right. And you said that earlier with respect to EWA, and you said that's why we don't need an APR.
Not that we don't need it. It's a bad judge for this model. It's a bad system, as was said earlier. It's a bad system for this model.
Okay, but we need it for credit cards.
I think
and
APR. I think
Okay.
I think there should be a mechanism to create standards and protections for consumers. As an organization, I want to be clear. As an organization, we represent a number of online lending companies as well. We believe in a 36% interest rate cap, right? We believe in consumer protections ultimately for the consumer. For a lot of, again, in a lot of states that have not thought through or understood when the laws were crafted in the 80s or the 20s, as we heard going back all the way, some of the products that exist today. And so we do believe that there needs to be a standard, 100%. There's not an industry representative who's going to speak to you today who's going to say we're against a standard or against it. I think it's the appropriate standard for the appropriate product.
Yeah. No, I just, it's interesting. I've been on this committee for a few years and we've had debates about APR specifically. And we've heard the arguments, well, APR shouldn't apply to this because it's different. I mean, we could go down that road and all day long with all types of different products.
I wouldn't say it's
So, the fact remains that it is a standard. It is a way that we can calculate the total cost, if you will, of a product. And it's one that people may not know what their APR is on their credit card, but they know what it is generally. And there's a way to calculate APR. So I don't think that means that it should be a standard that is inapplicable.
Oh, I want to clarify. And I
products like
apologize if that was
these.
not clear. I don't think it's inapplicable. And we speak about APR all the time on products where it makes sense and where it actually works. I mean, you heard banking sort of department try to explain to a representative how to calculate APR utilizing this product. And it was comical. And that sort of goes to like a consumer who doesn't understand finances
Right.
trying to
Right.
understand what that charge is going to be.
Right. But you just said you don't know what the APR is on your credit card.
I don't.
So, right. So isn't it the same thing?
So again, but I believe there needs to be consumer protections built in. I know that if I'm late, I don't thankfully, I'm able, I don't make late payments on my credit card. I try to pay off my bills every month. I try to be responsible with my finances. I think that's what we should be encouraging, right? The consumers need to have the tools that they need to get from point A to point B from day to day. For me, it's going to look very, very different than another consumer, right? And so, yeah, I think that a consumer who does not want debt, right? I don't want to think about compounding interest. I just know I have a bill due tomorrow. I don't get paid till Friday. How do I act? How can I do that? And I've already accrued 4 days worth of wages. Why shouldn't I be able to access that in a fair, reasonable, responsible way?
They should also know what it costs. So
Agreed.
we could go back and forth.
No, I don't, and Representative, and
anyone
I'll
else?
just,
Okay.
I would just say is that I agree. And I think every company says they're transparent in what the cost is. Why are we trying to squeeze it into APR when a company says it's a flat fee? Here's what it's going to cost. We're going to tell you exactly upfront in transparent terms. We're not going to hide it in the fine print, and we're going to do our best to ensure that the consumer understands exactly what they're getting. And I think that's ultimately what we should try to do. I think sticking to sort of historical sort of processes for the sake of doing it, I don't think does the consumer any benefit.
Thank you. Thank you, Phil.
Thank you.
All right, next up, Monica Burks. Monica, there's. Hi, Monica, welcome.
Good afternoon. Thank you so much for making time for me to speak today. My name is Monica Burks, and I am Policy Counsel with the Center for Responsible Lending. It's a nonpartisan research-based organization, and we are here today to, first of all, thank you for the diligence that it is evident you put into crafting this bill. There are some very important protections that are already there. Unfortunately, we do have to voice our opposition in general to the bill, mainly because regardless of how we encapsulate the fees for these products, the expedite fees do represent a form of finance charge for consumers. And to carve that out from your state interest rate caps makes users susceptible to what is essentially price gouging. And I know that it may seem inflated or astronomical when you get into the hundreds of percents when you put these in the form of an APR, but over the course of a year, if a person is using these products to get groceries and gas, those fees add up. And a lot of time it's the fees that causes them to relend, to reborrow frequently. You heard one person testify over five times a month. That's a pretty frequent basis. And so our main concern here is in the state of Connecticut, the law has already made a policy decision. They have already made a decision on what the appropriate balance is between a consumer being able to access these products and not having to submit to unconscionable pricing. That is what your law did when it capped the interest rates. And that is what happened in the fall when you reiterated that APR includes things like expedite fees, voluntary payments, and so on and so forth. So I don't want to rehash what has already been said today, but I'm really eager to hear if you have any questions.
Any questions? Representative Foster.
I really appreciate you being here and sharing a consumer protection perspective. I'm looking at the calculation, and I am curious about like the average person who's using this, let's say like to make a food payment. I should specify that I'm an anti-hunger researcher by my day job. That's like the bread and butter of what I do. And people who like occasionally go hungry, actually, it's not like every month typically. It's like usually 1 month in a year that like an unexpected car payment or an unexpected doctor's bill comes. And that's like the thing that makes the difference between them having enough food and not. And it's not usually like there are lots of people who have recurrent experiences of hunger, but for most people living in the United States, and especially true in Connecticut, it's much more intermittent. And so what happens if a vehicle like this isn't available and someone has like one of those incidences? What other options do they have available to them? Like, is there an alternative proposal? Because I'm feeling I actually, like, I want to be clear, I'm not defending this because I'm not sure. I'm here, I'm listening and I'm learning. But as I'm looking at the math, I'm like looking that I don't think it would work out, right? If you do it one time. So if you do it like one time in a year, and I'm hearing that's not what most people are doing, which maybe is justification for wage differences more than it is for anything else. But what is like, what are their other options? So like, I feel like we can't say like, this is not okay, and then say there's nothing else.
Thank you so much for that question, and thank you for sharing with me what you do, because honestly, the reason why I am at CRL is because I care about these issues, and I really wanted to dedicate all of my education and experience to working on proactive solutions for consumers. Like you said, unfortunately, these products are not one-offs for most of the users. And the bill that we're looking at right now doesn't limit the use of these products in that way. So I don't want to be disrespectful and not answer your question. As a matter of fact, it would elate me if we could have an in-depth conversation of real solutions that people could have to close that gap between wages and their living expenses. But right now, as you see, we are in a place where dozens of actors want to have their business model ensconced in state law without consumers' actual safety being prioritized. What that means is the opportunities to innovate and for them to think about how can we make this a safe way to access this without digging them into a deeper hole. Because the reason why I'm focusing on the frequency of use is because that is the business model. If you don't have enough money for groceries the first time you take it out, you're getting the loan that you have to pay back when you get paid. You're paying the fee that you have to pay back, and you're going to have to reborrow because you're actually in a deeper deficit. So even if it was just to purchase dinner that day and you paid $5 for the fee, you're going to have to take that money out again to continue to pay that gap. So I do acknowledge that solutions are required, and I want nothing more to focus on that. But right now, what we're trying to do is hold the line from people having to drain already low wages into these products. And so I want to return to my point, a policy decision on how much of these fees or APRs or whatever finance charges, however you want to refer to it, that policy decision has already been made and is represented by your state rate caps. There is not a significant difference between payday loans and earned wage advances. There simply is not. And I don't think I need to convince anybody seriously of that here. And because these are identical to other lending products that we've seen, you don't need to create an entirely new regulatory model. And I wanted to note that.
Can I ask if, in the traditional payday lender model versus these examples, is it different? Because what I've been told is that there's no collection mechanism if you're delinquent, you just don't get offered more money.
That sounds great and it might be helpful. However, there's no collection mechanism because over 90% of people who use these pay them back because, as you mentioned, they're in vulnerable positions where oftentimes they have limited options. So of course they're going to pay that back so that they continue to access it, right? So you don't, as a business, I'm not going to spend the administrative money repeatedly to report to someone's credit report for an average $80 loan. It doesn't make business sense to do that. So focusing on whether or not they are filing with the collection agency or taking persons to court is not relevant to the idea that these are predatory loans to the extent that the fees drain the low wage income earners' pockets.
Last question. I always try and policy make, but also like understand the numbers from the perspective of the people who are going to directly benefit or use a program. And one of the things that I know about people who live paycheck to paycheck from the data and from my research is that if we offered SNAP, for example, which functions much like a debit card, at a more frequent interval, that consumers who benefit from SNAP would feel more comfortable and allocate their money more regularly. And intellectually, this feels like a way that they can use their unrestricted personal cash funds in that sort of more spaced way for a fee. And because price gouging exists, that is predatorily impacting people at a grocery store, for example. So like when EBT cards are reloaded, the grocery store prices go up for produce, for example. Because that exists, like being able to use your earned income flexibly might protect against something like that. And I don't know that that math works out. I'm just speculating. But I don't want to legislate that they would lose access, because my constituents who've emailed me about this
Yeah.
are saying it's a helpful, useful tool, and it's a preformed email that they didn't write, right?
Right.
But like, I wanna sort of say, like, I'm nervous about taking away a tool that they're saying
Right.
helps.
The reason why their access is at risk right now is because the companies who are providing these products refuse to negotiate on terms that genuinely, meaningfully incorporate consumer protections. That is why they're at risk. And so when we talk about the current draft of this bill, and we're thinking, I love that example of the SNAP and the EBT and having access. It costs about 4.5 cents to provide instant access to funds for people through the electric systems that they use to deliver money into people's accounts, or, to provide those funds. Inflating that fee to $5 is predatory. And I'm no mathematician either, I'll tell you that right up front. It's why I became a lawyer. But if you do the math on the inflation between paying about 5 cents to $5 that you're passing to the consumer, right? In that context of a SNAP card, the government, hopefully, assuming they're probably going to pay the fee so that the beneficiary can access those funds. But here, that's not the case. Those fees are being pulled from the pockets of the vulnerable users who are accessing it. And so we're here today because while we are not advocating that there not be access to these products, we are aware, because of decades of research and lived experiences, that products like these leave consumers in a worse situation. And the carve out, however narrow it starts, it's never going to remain that way, as you can see this afternoon.
Representative Delmicky.
Thank you, Mr. Chair, and thank you for your testimony. You made a comment that fees add up. Is there any data on the average person that uses this product and how those fees add up, just for a reference?
Absolutely. So immediately a few resources come to mind, and I would be glad to send that to you once I'm done speaking. But just off the top of my head, the Department of Financial Innovation in California did a very large review of actual transactions, and they found that, once again, the APR was in the 330% range for employer integrated products. So without taking us down that path of the significance of APR, that is what that regulatory body saw fit to conceptualize the cost of these products. On the other side, we have the Government Accountability Office that found last year, on average, people use these products, I think it was already mentioned, between 26 and in the low 30s per year. You also heard someone testify 5 times a month. So those numbers let us know 2 things: that people are becoming increasingly reliant, and they're having to refinance to recoup the money they're spending to access. They're basically paying to be paid. And that also lets us know, being a research-backed organization and watching this space for so long, and I think the Department of Banking did a great job tracing that history, that these are identical to payday lending products, especially your direct-to-consumer.
Unless I missed it, do we have any data on the average amount of fees that somebody would accumulate per year on a product like this?
I do not have that information stored, but I know we have the average APR, but I don't have the fees in dollar amount. No, so that was a forecast of, under the bill draft as it stands now, that was a forecast of how much a person could pay under this bill.
All right, thank you for your testimony.
Thank you for your time.
Okay, thank you, Monica. I've been informed that we skipped Charles, who's now on the Zoom. So we have Charles Bell. Charles, go ahead. You have 3 minutes.
Hi, good afternoon, Chairman Doucette and Ranking Member Dolnicki. I'm Charles Bell. I'm Programs Director for Consumer Reports based in Yonkers, New York. I'm a financial policy advocate working on credit and lending, and pleased to have submitted written testimony relating to this issue. Our concerns are quite similar to the concerns you just heard from Ms. Burks. And we agree with the other national consumer groups and local groups that are testifying today that we think the status quo under the guidance promulgated by the Connecticut Department of Banking is really the gold standard for protecting consumers from usurious financial fees related to payday lending and high-cost earned wage advance products. We don't have an issue with earned wage advance if the employer absorbs the cost of the fees. And what I would say is we are crossing the Rubicon here as a nation, trying to determine what's a fair cost for a product like this. And our point of view is very strongly that we should not be shifting these fees to workers. We've accepted all kinds of other junk financial fees earlier in American financial history, where now we have merchant fees for credit cards. We have ATM fees of $5 and sometimes a foreign fee. We wish that when we had gone through those processes, we had given those fees greater scrutiny and make sure that they are affordable and related to the actual cost of providing that service. But in this case, we are highly concerned that consumers will be exposed to fees in the low hundreds of dollars each year for these products because they are subject to patterns of repeat usage. I think in California, they found on average they're used 36 times a year. Some of them have monthly subscription fees and they have the expedite fees. So it can really add up. And so you're taking a low wage worker who's working at fast food or a retail establishment and draining hundreds of dollars from their pay. And so we don't think it's fair for the employers of the country who get like a favorable image because somehow they've offered this service to their workers to get a favorable reputation based on shifting that type of cost to their workers. So we'd really like to see employers exercise responsibility, pay people a decent wage to begin with so they're not in a liquidity crisis and they can't afford to meet basic needs, but also not to add in high-cost fintech products that have much higher interest rates than credit cards. So that's our point of view, and we're hopeful that the CFPB at the national level will be clarifying the guidelines and rules of the road around these products. So we'll have a much better policy environment. But until we have that, we think Connecticut has done really well with the Department of Banking guidance, and we really urge you to stick with that. And we appreciate all the work that went into this bill. It has many good provisions that we support, but we don't think it's right to carve out the expedite fee and the advance fee from the usury laws and the requirement to state APR. So thank you very much, and I appreciate the opportunity to speak to you today.
Thank you, Charles. Any questions? Any questions? No? Okay. Thank you for joining us, Charles. Okay, next on my list is Molly Jones. Hi, Molly. Just press that button. There you go.
Thank you. Thank you, Chair Doucette, Ranking Member Dolnicki, and honorable members of the committee. For the record, my name is Molly Jones, and I'm the head of public policy at PayActiv. We are an employer integrated EWA provider that has been providing EWA services in Connecticut for over a decade. We partner with over 350 employers in Connecticut, and over 10,000 workers have access to this service if they need it. We appreciate your efforts to restore earned wage access services for employers and their employees. Since the implementation of the Department of Banking's guidance on January 1st, we have suspended many of our EWA disbursement options in Connecticut, including those that the users value most. This is the first state where PayActiv has been forced to do that. While we continue to offer several free options, we have seen EWA usage drop significantly as a result of these changes. It is likely that users have turned to online payday loans, bank account overdraft, and credit card debt for their short-term liquidity needs in the absence of EWA. We've also received numerous complaints from our employer clients and our users who value being able to select which transfer option was most aligned with their financial needs at the time. In a survey of our users in Connecticut, the majority reported their financial wellness is worse off as a result of the department's guidance. We appreciate the work of this committee to improve the financial resilience of Connecticut workers and restore access to this benefit. And we look forward to working with you on amendments to this bill that would align this regulation with how the product operates. I think, as mentioned before, employers contract with a provider like PayActive to offer this service as a benefit to their employees. We integrate directly into the time and attendance payroll systems, and we make an accessible balance available to workers if they need it. Since workers are accessing only their own earned wages, this product should not be regulated as a loan. There is no difference in the user experience from the company that was granted an exception to the law. And given all the focus on fees and APRs that we've discussed, it's also important to highlight that we offer 5 free options, and that provider does not have a mandatory free option. And that provider also charges inactivity fees and higher overall fees than we do. Additionally, by modifying the Small Loan Act, something that has not been discussed yet, it's our interpretation that this bill would require all employers to be licensed in Connecticut, which we can all appreciate would be a significant hurdle and effectively end the benefit for Connecticut workers. Again, thank you for your time, and I'm happy to take any questions.
Thank you. So I'll ask the same question to you that I've asked to some of the others. It's a very narrow one. Which specific amendments would you like to see to the bill and that's before us today with respect to the licensure piece and also with respect to the transaction cap piece?
Yep.
Again, that we're working within the confines of the bill before us and not, doing a wholesale redrafting or revision of our.
So we do not agree that earned wage access should be regulated as a loan. So would support looking at an amendment that looks at a different piece of statute. I believe also by amending the statute that we have, the Small Loans Act, that would trigger the requirement for the employers to get licensed as well. So again, we would not look at that. We do support a $5 fee cap in the bill. It's our understanding of our user behavior that oftentimes, when you have an acute financial crisis, you might use earned wage access more than twice per month. And I think that monthly cap is prohibitive to the needs of workers when they need this product most. There's been a lot of numbers thrown out about how often EWA is used. I think those are actually the only data I have seen reported is quarterly, and those numbers have been multiplied by 4. And I don't think that's representative of how frequently it's actually used over the course of a year.
Okay. But to be fair, we're not, the bill before us is not restricting the number of transactions. It's restricting the cost of those transactions, right? So you said you offer free options, or you could figure out another way, presumably, to offer more transactions that would be above the fee cost cap, correct?
Yeah, so since the implementation of the guidance, we have suspended the paid instant delivery to any bank account. And we've also suspended our free ACH transfer. We actually lose money on that free option, and we're no longer able to offer that because that was offset by the other fee. So we have instant delivery to our PayActive debit card. Users can opt to do that should they choose to. Many don't want to set up direct deposit to that card. They don't want to change their banking relationship. So they prefer to pay the $3.49 fee.
Under this bill, you'd be able to resume that service, but it would just be subject to a cost cap, correct?
That's correct. Yeah.
Any questions? Representative Dilnicky.
Thank you. Thank you, Mr. Chair. Just a follow-up. We heard earlier that there are some of these providers that aren't going to be licensed or wouldn't have to be licensed. Do you feel that PayActive should be one of them? And why?
Thank you for the question. I do defer to the Department of Banks in this committee on that distinction, but it's my view that from the user experience, there's no difference in if the provider is using the employer's funds or their own funds. From our experience in the market, most employers don't have that liquidity to use their own funds for this service, and it's really stymied the growth of that model to a very, very small segment of this provider space. So certainly would want to look at how many fees the users are paying, what their free options are, and what their user experience is over where that money is coming from.
You also mentioned, how many companies in Connecticut?
350 employers.
Are you willing to name off a couple of the larger ones just out of curiosity? So we have a feel for how this market is.
Yeah, we partner with a number of large employers. I'll have to get back to you on what I'm allowed to say in this setting.
Yeah,
Thank
I'd
you.
be curious to see just what companies are actually utilizing this and working with this and get a feel for how many folks have this already, currently would have had it available prior to the regulating of it.
Yep. Happy to follow up with that.
Thank you, Mr. Chair.
What else? No? Okay. Thank you for joining us.
Thank you for your time. Appreciate it.
Next is Rafi Podolsky.
Thank you, Mr. Chairman, members of the committee. My name is Raphael Podolsky. I'm a lawyer with Connecticut Legal Services, which represents low-income households in Connecticut on a variety of issues. There's not a whole lot that I can add to what you've already heard, but I filed written testimony, but I'm just going to make a couple of comments, I think, in the 3 minutes that I have. First of all, I think all of us who are interested in this bill are appreciative of the fact that the committee has narrowed it from what we kind of originally understood the proposal to be. And so that's very much a plus, including things like retaining the classification as being as a form of a loan, and applying caps to it. So that's an important part of this. We nevertheless feel that the best guidance is to stick with the banking department's guidance. And that's ultimately because this is a product that we think fits. A couple of things that I've heard asked. It was pointed out that in an employer, well, in most of these models, one of the reasons that you don't have credit reporting is because the payback is nearly 100%. And it's nearly 100% because the payback comes back automatically, either out of wages through a deduction or out of some other mechanism that's being used by the company. What I see as the best alternative, I mean, I think it's a very legitimate question that was asked. What do we do when people need money in a hurry? And I thought one of the earlier speakers answered that, but that the issue has to do with the cost. And there are employers out there that absorb the cost themselves. They do not pass it on to the employee. And that's really these fees for the employers are actually small. For an employee, however, especially an employee doing repeat usage, they get to be large over time. And the nature of the product is such that people end up needing to use it more frequently. That doesn't follow that everybody uses it frequently. Obviously, somebody can have a one-time need for it and they use it once. But if you think about it, for someone who's using it 25, 30, 35, 40 times in a year, what you're really doing is, and this goes to some extent to the APR question, although I don't know that I fully understand. Representative Foster probably understands it better than I do. But it's like you're recycling the same money. In other words, if you're pulling $100, the APR relationship comes because you have to pay it back so quickly. If you didn't have to pay it back for a year, the APR would be much lower. But you've got to pay it back in a week, more or less, and it's going to come back automatically as a deduction out of something. But if in 2 weeks you need another $100, in some sense you're recycling the same $100. You paid for the $100. Now you're going to have to get it out again because it wasn't $100 for a year that you could use as you needed it. You pull another $100, but it's sort of the same one. You do it 30 times and you pay 30 fees. There's a legitimacy in using the APR as a way to measure that. I guess that's all I want to say for now, at least without my claiming to have any real expertise in how APRs are calculated. I'll leave it at that. If there are questions, I'm happy to try to answer them. I think you've got some witnesses here besides me who can better answer some of those questions for you.
Thank you, Rafi. Any questions? Any questions? No, none. Okay. Thank you for joining us, Rafi.
Thank you.
Next, Garth McAdam, who is joining us remotely and is online. Hi, Garth. Welcome.
Hi, thank you. Thank you for your time. I apologize. I'm a little bit sick, so I've got a frog in my throat today. So first of all, thank you very much for the opportunity to speak today. This is clearly a very important issue for a lot of people, as you can see by the long list of people here to speak. I'm going to try to go through this quickly because I know a lot of this has been touched on already. So I'm from Zayzoon. I'm the general counsel. We are an employer integrated EWA provider, and we mainly work with small to mid-sized businesses. So sorry, I have prepared comments, but I'm going to try to skip over a lot of it. So, and to get to the meat of the two questions are, what are we looking to do with the bill? I think specifically we would like employer integrated EWA to be entirely carved out of this bill. So in the same way that the flex wage model was, we believe that should be applied to all of employer integrated EWA. So, and the reason for that is we believe that if an employer integrated EWA provider wants to avoid licensure as a lender, they'll have to push the burden to fund these advances onto the employer. And since we mainly work with small to mid-sized businesses, we understand their cash flow. And there's research from JP Morgan Chase that shows that 50% of small businesses are operating with fewer than 15 days cash buffer. And this concern is especially prevalent in Black and Hispanic communities. So the reality is these businesses are operating paycheck to paycheck as well. And by pushing the burden onto them to fund these advances, as opposed to the EWA provider, all we're doing is requiring these businesses to take on additional debt, which burdens the business, causes greater cash flow uncertainty, and increased risks of bankruptcy. So I also believe there's additional policy reasons. We partner with payroll providers and employers, some of whom have informed us that it's corporate policy to not partner with lenders. So if we just get this status that we're a lender, all of a sudden we could be turned off in Connecticut by our partners. So not even by our choice, but by our partners. And then further, there's the question mark of app stores like Google Play. Google Play has a policy that they don't allow personal lending apps. This is in my written testimony as well, so I won't get too into it. But by classifying employer integrated EWA as a loan, it could also mean that our app is not available to Connecticut workers. The same will go for Immediate, PayActive, WageStream, the other employer providers that have spoken today. So another addition is that we would like to see the fee cap removed. I do understand that it's the fee cap, not meaning that per transaction, but the 30-day fee cap. So while we completely understand the desire here, and that's to limit the amount of fees incurred by the consumer, we would encourage this committee to view fees not just solely in an EWA vacuum, but also benchmarked against the costs incurred by consumers from not having access to EWA. So this is them being pushed into high-cost alternatives like overdrafts, which are significantly more expensive than an EWA transaction. Additionally, because EWA allows our customers to access funds for things like gas for their car, access to EWA results in an average for our customers, an average of 8 hours less absenteeism per month. And that's clearly beneficial for the small business partners, but also means more money in our customers' pockets. So imposing the monthly fee cap puts that at risk because the consumers will no longer be able to access EWA if they've already hit that cap. So well, we applaud the efforts to sort of pull back on the restrictions that were in the original bill that came into effect January 1st. We do still have some concerns about HB 5140, and we would be very, very hopeful, and we have a great desire to work with the committee on amendments. So thank you very much for your time.
Thank you. Thank you. Any questions for Garth? Garth, I did have one. I wanted you to clarify something that you mentioned earlier. You said the Google Play thing was interesting to hear. No one's raised that yet. But you said that your payroll providers won't be eligible to, you won't be able to partner with certain payroll providers. Could you clarify or expand upon that point?
Yes, sir. So they have specifically told us, and it's not all payroll providers. It's not like a standard in the payroll industry, but a number of them have told us that they do not partner with what they consider to be any sort of lending associated with payroll. So by calling it a loan, then we would obviously fall into that and likely be cut out. So I think our response to that would just necessarily, because we're nationwide, our response would necessarily be we just have to carve out Connecticut because we can't put the rest of the nation at risk in terms of the availability of our service.
Okay, thank you. All right. See no other questions. Thank you for joining us, Garth.
Thank you.
Next, Tomanika Beach. Tomanika is also online. I see you there.
Yes, yeah, I'm online.
Welcome.
Thank you. I'd like to thank the Banking Committee for allowing me to speak today and for allowing me to give my testimony, because it's really important to me for me to express that. And I also want to thank Representative Foster for coming at this from a perspective of a customer. Earned wage access programs has helped me tremendously over the years. I mean, I could never, I'm listening to the everyone speak, and I'm kind of shocked to see that people would classify it as a loan. I don't classify it as a loan as the end user. I have always been able to take out loans. Actually not a loan, but I've always used it as a financial tool and was able to use it at a very, very minimal cost. For the most part, the most I've been charged is 7% on $100 if I needed to borrow. There are no bank or overdraft fees involved. So I am in support of earned wage access usage in Connecticut, and I hope that the law would look at it from a consumer's perspective, because it's really hard when you're living from paycheck to paycheck. I mean, by the end of the week or each pay period, my disposable income is like from $200 to $300. So there are times when I have emergencies, like I recently just had one where my aunt passed away and I needed to get a flight ticket. I don't have the money, and I was always able to borrow from or to use that financial tool from earning, and to know that it's not available anymore, it's very shocking, and it puts me in distress because I don't know where to turn to when I need a couple dollars if my bank account is low.
Okay, thank you, Tomanika. Appreciate you being here. I know, and on behalf of Senator Miller, my co-chair, I know you had reached out to her, or you, I think, testified at the BPRC.
Yes.
Hearing.
Puerto Rican Black and Puerto Rican Caucus.
Right, and of course she chairs that committee as well, which I understand that was a very long hearing, and this was just a comment in the midst of a very long hearing, but she took a particular interest on that, and certainly she wanted me to thank you for coming to testify. And your perspective is helpful because, again, we've heard from industry people, and we've talked about APR and things, but
and I just want to make a clear distinction that payday loans are totally different from earned wage access financial tools. So I used to live in the state of Nevada, and I had to borrow money once in a while. And the payday loans fees were like 460% on the interest rates. And that would be like what, $200 on a payday loan for 500. So earned wage access fees are at 7%, 6%.
Okay. The math, I know I think we all cop to not being great at math in this room, or not on the fly, at least when we're talking about this stuff, it gets complicated. So, but I did have a couple questions for you. So you mentioned Earnin, that's the service that you use?
Yes.
Okay. And my understanding is that Earnin is direct to consumer, meaning that you sort of found them somehow
online.
They're not offered through your employer, correct?
Right. Correct.
Have you talked to your employer, your HR department, or anybody about whether or not they do offer that, or does your employer not offer that?
No, they don't offer that. I work for Travelers, and they don't offer any of the earned wage access programs.
Okay. So they don't have any ability to see your actual paycheck. They're not involved with your payroll at all. It's just
none at all.
It's basically just an app that you found, correct?
It's an app that I found online. Yeah.
Been able to use. Okay. In terms of using that app, talk about the fees that you incur, because that's a lot of what we're talking about. I assume there are fees like transaction fees, and there are tips or donations that you can make. Is that correct?
You don't have to make tips or donations. They don't force that on you. I've the most I've actually paid to borrow $100 or possibly $200 is $7.99. I can't remember, but I think it's between $7.99 and $8 per $100. as far as I'm concerned, that's way better than me having to use my overdraft protection service that my bank provides me. If I needed to use $100, it's $38. The most that they give you to overdraft is $50. So anything past that point is going to be $38. Look at the comparison. That from what I can tell, I think Earnin has been way better as far as fees are concerned.
Okay, and how do you pay them back?
I
have-
automatically pay back on my next pay check when I get paid. It's every pay period. So if I borrow, so I get paid tomorrow, technically I get paid tomorrow, and then the next 2 weeks I can pay them back.
Now, do you initiate that payment to pay them back, or does it happen automatically? Does it come right out of your bank account?
I would initiate the payback. So if once I get my paycheck, I would actually go into my Earning app and apply a payment, or I'll process the payment on the app.
Okay, so you've never had it, the occasion where it's just been automatically deducted from your bank account?
I think you get the option to select that. You can, if you want it deducted from your bank account automatically. But for the most part, I think I've actually initiated the repayments.
But they have access, money goes in, money goes out to your bank account, right? That's the way
Correct.
that you get paid and that they get repaid.
Yes. And the good part about it is that if you have an emergency, you can initiate a request for a payment to be added to your account, and you get that within 2 to 3 minutes.
Okay. All right. Any other questions for Tomanika? No? Okay. Well, that's it, Tomanika. Thank you again for joining us, and thank you on behalf of Senator Miller. She wanted to make
Thank
sure
you.
I extended that thanks to you. Okay, next on the list is Alice Jacobson, who is online, I believe. Yes.
Yes, hello. So I'm Alice Jacobson. I'm the Director of Government Relations for Payroll.org. We represent payroll professionals. So as such, my comments are limited to the employer integrated models of earned wage access. We do not have any relationship with any particular vendor. Our members may have a seat at the table with their employer in terms of making decisions on an earned wage access benefit. I don't want to beat a dead horse here, and we have already submitted written comments, but there are a couple things that I did want to point out, which is that earned wage access is used by employees at all income levels. It is not just the lower income employees. That distinction is important because it just shows you that financial health is important at all levels. So the problem that we see with this bill is that it really isn't transparent when you try to measure a product in a way that is not what the product in fact does. It's really important for employers to be able to make decisions, as well as employees, when they have a true understanding of what a product is. And so that's what our concern is. We want to see transparency. We want to see all costs associated with it. But we're also well aware that in this country, with exception, we don't have control over how employees spend their earnings. So it really doesn't matter in that sense about whether you're getting paid on a Wednesday or a Friday or when you're being paid. Perhaps I can put it this way in terms of looking at regulation, which is that, you know, Carl Benz invented the first automobile in 1885. It was essentially a large tricycle with a motor. Now, you can regulate cars today in that same way, or you can recognize that even though the cars that we have today are still defined as a car, they are in fact a very different product and should be regulated that way. And that is essentially what we're looking for in earned wage access, so that employees and employers can make reasoned decisions about financial health benefits. Thank you.
Thank you. Could you remind me again which organization you're from? Is it a member-based organization? And who are your members?
Yes, I work for Payroll.org. We were formerly American Payroll Association. That name you may be more familiar with. We rebranded this past spring. So we're a nonprofit professional organization representing individuals who are in the payroll space. So we're not a payroll service provider. We're not a vendor in any way. And that's kind of the distinction. Our primary goal is education, and that is at all levels. Education for our members. We have a certification program, and also education to make sure that regulators and the community knows exactly what payroll is and what it entails in terms of daily operations.
Okay, so your membership is payroll companies, and does that include
No,
that include-
payroll professionals, individuals. So 50% of payroll is managed internally with employers using some kind of a software program. The other 50% are the payroll service companies that was talked about earlier in terms of payroll service companies not partnering with any products that are loans. Employers may be the same way, where they will not engage in a benefit that is defined as a loan. But no, we don't represent any companies. We represent the individuals.
Okay, so I guess what I'm interested to hear from you, from your particular perspective, is something I touched on earlier, which is sort of the regulatory question. You know, if we have a licensing requirement now, and there was some testimony earlier that certain payroll companies can't work with EWA if they have to be licensed as lenders. Can you comment on that at all? Is that your experience, or what might you be able to tell us about that?
Well, the problem when you call earned wage access a loan when it's a different product, it makes it more difficult for employees to understand what their options are and for employers to make decisions on what benefits to offer. And I know there's been a lot of talk on the fees, but you're really comparing the fees here between the different options that employees have. And the fact is that, at least from the employer integrated model, there's all kinds of benefits that employers share fees. I mean, healthcare, retirement, where employees and the employer contributes. Discount membership at the local gym is split between the employer and the employee. So it's not really unusual in that way. But licensing can be, as a loan or any kind of licensing, can be very complicated, and we are very concerned that fees could be increased if not regulated correctly. That's kind of an important factor there. So we want to be really careful of that. On the other hand, we do want a registration requirement. We need to know who are the players that are out there, who is a legitimate business, who is, predatory. It's not easy for employers to search through all of this information. And the same with employees. And along with that registration, we do support a reporting requirement and government oversight. All fees associated should be listed. Employees should have access to an analysis where maybe they could punch in and say, hey, if I use this 10 times a year or 10 times a month, what will that cost me? So that they can make those comparisons. And as far as we can tell, the vendors that are out there that work with employers have those kinds of options. Some of them even offer help for employees for things like budgeting assistance.
Okay, thank you. Any other questions for Alice? No. Okay, seeing none, thank you, Alice, for joining us today.
Thank you very much.
Okay, next on the list, I have Olivia Rinks. Okay. Olivia is not here. Next is Carl McCluster. Carl. Welcome. Thank you for your patience.
Sure, no problem. Thank you for being here and convening this time together. So In her absence, Co-Chair Miller, Miller and Doucette, Ranking Member, I'm just messing up people's names, Delnicki, Representative Anna Kosovich, and other attending members. I'm Carl McCluster. I'm the co-convener of the Connecticut Faith Leaders Collaborative, amalgam of houses of worship in Connecticut that number 1,700. I'm the board vice chair of Faith Community Development Corporation, a nonprofit here in Connecticut, and I'm the senior pastor at Shiloh Baptist Church in Bridgeport. Here really to talk about Senate Bill number 117, the act concerning the Martin Luther King Jr. corridors. Having heard the other testimony, I want to comment on that too, if I might be able to. We're asking for your support of an expansion of Connecticut's MLK Corridors Initiative. The MLK Corridors Initiative is built around 3 non-exhaustive primary key study and implementation areas. That is education, economic development, and housing, all of which are in deep need of continued support here in our state. It enables communities and their citizens to collectively engage on a parallel platform and thereby understand and implement equitable solutions to multiple issues that exist in all of Connecticut's municipalities. And that's really important because it puts the players in the community on the same level so that citizens are talking to investors and to business people and to everyone else. It's a collective work. This is especially important to ensure that the voices of the indigenous and existing residents are given level or at least equitable voice in the community's right to self-determination, as well as protection against wealthier and often less scrupulous investors. I point to Atlanta as an example. Read the Atlanta Journal-Constitution, the 5 hedge funds that bought up all the single-family houses in Atlanta and then would not resell them, only rented them out, thereby controlling the rent market as well. And it costs as much to live in Atlanta now as it does in Connecticut. Who knew? So let Connecticut be Connecticut. So that's my comment on that. Should I continue the other now or wait till after you question me about that? Okay. So I sat here listening to this act concerning earned wage access and thought about all the people that we saw in our surveys around the state, the people that were desperately trying to make it from paycheck to paycheck on one hand, and also the others that were so beset by payday lending and other types of schemes. It seems that there's a principle at work here, regardless of the source. For example, regardless of the source of a clearly visible potential injury, there's a responsibility of members, citizens, organizations, and government alike to protect citizens, whether, sorry, read my own writing here. Okay.
Minutes, if you want to just sum up briefly.
Sure. If you get in a car and you don't put on your seat belt, if you're an adult, you're responsible for putting on a seat belt. A child doesn't have a seat belt. The adult in the car is responsible for the child's seat belt not being on. Either way, if the seat belt isn't on and the car crashes, someone gets injured. So when I listen to the amount of money that we're talking about, it seems like small numbers when you really look at what any type of it, I want to compound that over the period. So I paid 4% for 1 month. And then I did it again, or the next week, and the next week, and the next week. What does that number look like? That doesn't look like 4%. It looks like predatory lending to me. And so I pray that we'll avoid that pitfall that seems clearly evident to a layperson like myself. Thank you for that.
Thank you. Thank you. And thank you for coming out today. And again, on behalf of Senator Miller, who couldn't be here. And thank you for giving us a little bit of a break to testify on SB 117, the MLK corridors. This is something we've heard about for the last couple of years and has been successful. So remind me, where are you from? Are you from an area that it has one of these corridors established or
No.
designated, or one that is potentially looking at something like
One
that?
that is
if it was-
potentially doing it. I'm the principal in a group called Freedom, Faith, Restoration, Empowerment, and Economic Development Outreach Ministries that won the RFP for the last Corridors Initiative. We did it in Norwalk, in New Britain, and in Middletown. And so there are 4 other corridor areas in Connecticut that haven't been addressed. All of them are similar condition. You know, if you go to those areas, basically MLK corridors in the 60s, streets named after Dr. King in the 70s were glorious places close to downtown. As the economy has changed and housing has aged, then now those same areas that were once, you know, housing authority areas and things like that are really under the desire of a different type of housing. We're how many thousand units short of affordable housing in the state of Connecticut? We have funds at the Department of Housing to address that issue, but it isn't really being addressed because the very land that where affordable housing was is now too valuable for regular people to live in. And I think that's unfair. I think there ought to be equity in that opportunity. And this addresses the community's ability to come together and make that decision themselves and not be pressed simply by an investor to make that decision.
Great, thank you. Any other questions for Carl? No? Okay. Seeing none, thank you for joining us, Carl.
Thank you.
All right. Next on the list is Philip Cronin, who I believe I see online. Philip, you can go ahead. Thank you.
Thank you, Mr. Chairman. Honorable members of the Banking Committee, my name is Phil Cronin with Chime Financial speaking today, respectfully in opposition to House Bill 5140. For background, Chime is a financial technology company founded in 2012 on the premise that basic banking services should be helpful, easy, and free. In Connecticut, we serve more than 60,000 consumers through our partnership with 2 OCC chartered, FDIC insured banks. And we lead the market in providing banking services for free, including free checking accounts, savings accounts, faster access to direct deposits, free overdraft, as well as credit building. The General Assembly's discussion of this bill indicates that the legislature is aware of the primary issue at hand, and that is more than 65% of Americans have low cash balances that are being exacerbated by lengthy, antiquated pay periods. On-demand pay, which would help employees with their financial controls, is not widely available. So in light of this, Chime is exploring ways to bring to market a safe, low-cost, earned wage access product that can democratize access to liquidity for our members by simulating on-demand pay. Lawmakers are at a critical juncture where a safe, scalable EWA framework can be created. However, by limiting earned wage access licensure to providers with an employer integration, House Bill 5140 will exclude models that are providing the same core consumer protections that lawmakers are seeking to promote, that being access to and settlement from actual wages. So we agree with Connecticut lawmakers that providers that are enabling access to and settlement from actual wages are distinct from those that may more simply be underwriting consumers against their income, deducting general funds from their accounts. However, lawmakers should not define the core characteristics of a consumer-friendly EWA product by defaulting to the employer-integrated definitions in this bill. This will severely limit the availability of earned wage access in Connecticut, and in our opinion, harm consumers in that way. In our written testimony, we detail how EWA with these core consumer protections can be provided without employer integration, and we implore lawmakers to recognize that they can adopt an EWA policy that promotes the consumer-friendly characteristics of enabling access to and settlement from an employee's actual wages, regardless of a contractual relationship with the provider. So we believe with some adjustments to the bill, the legislature could create that framework to meet the needs of Connecticut residents while preserving the bill's intent, and would be happy to work with you to accomplish that. So thank you for your time. I'm happy to take any questions.
Thank you, Phil. So you said that your product or what you're talking about here simulates on-demand pay. Is that correct?
That's correct. And just for the folks' knowledge, this would be a direct to consumer product as opposed to an employer integrated product, just to clarify that.
Right. Okay. Well, that's a creative way to describe it, simulating pay. I'll just leave it there. Any other questions? Okay. If not, thank you, Philip.
Thank you.
John Erlinghauser.
Good afternoon, Chairman Doucette, Representative Delnicki, members of the committee. I will save you the aggravation of having me read this testimony, which I submitted. I think I will just comment and make some observations based on some of the things that I've heard today. And I will start by saying, by no means am I a mathematician either. I was a political science major. And actually, I was under the impression there'd be no math here today at the committee hearing. But having said that, for Representative Foster, who's not here right now, 300% APR, it costs 10 times more than using a 30% credit card that you can pay off over time as opposed to in a pay period. So I think we need to keep that into account when we're thinking about these loans, because frankly, that's what they are, loans, as much as the industry is tying themselves in knots to, use verbal gymnastics to say they're not loans. We agree with the Department of Banks respectfully, and we do appreciate, the lengths that you've tried to go to make this bill acceptable. But we do agree with the Department of Banks, and several of the providers had made comments that they want strong consumer protections. So, being the political science major I am, I kind of looked at the ledger and said, okay, who's here and who's here? And on the side of the equation that ARP is on, we have the Center for Responsible Lending, the National Consumer Law Center, Consumer Reports, the guidance from the Department of Banks, and then the providers on the other side of the equation. And, I also looked to the Consumer Financial Protection Bureau that, said recently that, these products share fundamental similarities with payday lending products. And I agree with the pastor, which is one of the main reasons we oppose these bills. We spent a lot of our time working to ensure we have strong financial protections for people, and they also have the ability to have a strong and secure retirement. But these products just end up causing a cycle of debt over and over and over again, 36 to 100 transactions a year. And there's a reason. It's not because, even the woman who testified from Travelers, called it borrowing money. And you're in essence borrowing money. And there are other options out there that people can do. And so, even based on this bank, when you're talking about capping it at $10 a month and you're saying, well, why would that be predatory? Well, that's $120 a year. And for people that are in low incomes and low wage jobs, that's a lot of money. And frankly, we think employers can, pay those fees and use it as a benefit. If you really want to, because I know some of the providers talked about that. Well, this is a benefit, it draws in good workers. I've been working in the retirement security space for a long time within ARP for 20 years. And, a real draw and a real benefit would be if the employers were picking up those fees. So, I respect that the fact that the committee is trying to do its best to find something that's equitable, but, we actually think the guidance as it stands is good. And Connecticut is a leader in this, and we shouldn't, lower the boat to some of the other states. We should continue to be a leader, and we should be setting the stage for what should be happening across the country. So I thank you. And again, as I say, there are more experienced people on the consumer advocate side that can answer questions, but I would do my best to try if you have any.
Thank you, John. Any questions for John? Anybody?
Okay,
No?
thank you very much.
Okay, thanks, John. All right, next on the list, I have Tanisha James, who I think is online. Tanisha, are you there?
Here.
Oh,
Hello.
you are. I can hear
I'm not
you.
sure what's going on with my video. I do apologize. Can you hear me?
I can hear you. Yeah, you said you can't get your video on.
Yeah. I can't get my
Okay, and I'm
video.
echoing a little bit, so I don't know how to fix that.
Yeah,
but-
I was trying to adjust my microphone.
Okay. All right. Yep.
Oh,
You can
wait
go
a
ahead.
minute. It says start my video. There we go. I'm so sorry.
Oh, there you are. Hi.
Okay, all right. Hello, thank you, everyone. I'm a little bit nervous, but I do appreciate the committee for taking the time to hear my voice. And as a consumer directly, regardless of what side of the fence you're on, you're talking about me, someone specifically and directly. So what I want to just say is that I've heard a lot from everyone on both sides, and I would like to think all of the EWA representatives that, spoke on the significance and the distinction of having it not just be classified in just one specific category. And my whole thing is with this experience that I've experienced, I've used earning, and I think it's a good benefit because for people like me in Connecticut, when you're getting paid biweekly, you do have those type of challenges, especially after the pandemic, everything that's went on with the economy, inflation, and it's hard for I'm a single mother, whether you're a single parent, and even people from day to day that go through significant challenges, you have the opportunity to take advantage of wages that you've already earned. So I think that that's the significance because when we're talking about loans and payday advances, they have their little either you're going to pay a monthly subscription, you're going to have those same high cost fees. And with earning for me, I can have that advantage to where, and it's upfront. They don't hide anything. If you want to get it right then and there, you're going to pay that specific amount. And that's it. If you want to plan ahead, you can do that as well. Is goes right into your checking account and you don't have to worry about no extra fees, anything. If you want to tip, you can tip. It's not required, but they also have other advantages like the tip jar. They have credit builder. So there's also additional fees with this particular app that I've experienced that's different from those other apps where you download them and you have to pay that subscription to keep it going, or it's something else significant behind that you don't even understand because who has the time to really read through all of that when you are in the time of need. And there's no difference between both of the companies. My thing is if you're going to say like is you have three different items. You have pudding, you have pie, and then you have pudding pie. They're all in their own respectively categories. And if we're going to regulate some type of I don't know, licensure or whatever. I don't think the EWA is saying that they don't mind having those type of regulations. It's just that why should they be in the same category of all these other loan companies, advantages companies that have all these other hidden fees? That's to me, that's costing me more than being able to have access to funds that I've already earned. I've
Okay.
already earned these through my employer, and that's verified. And you don't have to worry about whether if the employer is going to sign up. Why should it be in the hands of the employer to decide whether they're going to eat the fees or they're going to pass the fees on to me?
Thanks,
Because
Tanisha.
if I'm already low income, I can't afford those fees.
So Tanisha, that's your 3 minutes, but
I'm
I was going to
sorry.
ask you a question about that too. So
Okay.
you said you use Earnin. So that was
Yes.
my first question. And then my next question was, you said your employer doesn't offer it. Where do you work now?
I work at Elevance Health, which is like Anthem Blue Cross Blue Shield.
Okay.
But I want to say before that, I had a part-time job at Walmart, and the economy was so with inflation and everything, I was only getting paid $14 as a cashier, still getting paid biweekly, and they had their own little app where you can access your funds. But once I stopped working at Walmart and I started part-time with like Amazon or whatever, if employees are not signed up, oh, I'm so sorry. If employees are not signed up with that specific service, then I don't have no benefit. I don't have no benefit. The great thing about earning is not tied to whether my employer is signed up. I can just go and I can use the service. I can use it free. I have all these other advantages. And then it's based off money that I've already earned. They take a look at what you've earned for those 2 weeks, and when you get paid, whatever I take, if I decide to put it directly into my checking account, then it's free. I don't pay anything. The only time that I've paid anything through Earnin is when I've decided to get an immediate, like, I need that right now. I'm at a gas station. I need $40 for gas. I'm going to pay that fee. Okay, that's fine. And other than that, you don't pay no fee unless I decide to give a tip on top of what I've already been able to access through my own funds that I've already earned.
Okay, that was my next
It's
question. You mentioned something called a tip jar. I haven't heard about that. What's that exactly?
Well, that's another feature that Earnin offers besides the credit builder advantage. They like, so when you can decide to set up how much you want to take out your paycheck in addition to whatever you've already spent. So if I've taken $100, I paid that $3 fee to get it immediately, and then I can decide to add a tip or just pay that 103 when I get paid. In addition, in the tip jar, which is like a savings, you can add $10, $5, and what they'll do is they'll hold that for you. So it's a tip jar, but it's also like a savings account. So additionally, again, this is not the same as these cash advance payday loans where it's like, they're saying, okay, I'm going to give you our money. And then when you get your money, we're going to take your money, as opposed to earned wage access. It's based off of what I've already earned. So I'm getting my money 3 days earlier because I had an emergency and I needed access now. Or maybe, okay, I don't get, I got paid 2 weeks, I paid all my bills and I'm broke. And the week that I don't have no money, I need $60 for whatever, or I want to have $100 to get me through that week. I have the advantage of going in and saying, I want to take that $100, and they're going to put it directly in my account. And 1 to 2 business days, I get that $100. And then when I get paid, that $100, if I didn't leave a tip, that's all that I am deducted from my account. There's no additional hidden fees. They don't ask for anything additional. I just took $100 from my paycheck in advance, as opposed to loans, APRs, cash advantages. You have to do this to get that. I mean, it's like it's a disadvantage to people like myself to say that we can only have a particular service in one square box that dignifies who I am, as opposed to you loaning me money and me getting the money that I've already earned.
So you mentioned too that you have paid them back from the means of Earnin deducting the money right out of your account?
Yes, you can choose to either wait until your payday hits your account for the funds to come back out of your debit card or your checking account, or you can go in and say, okay, I have this money now, I'm going to pay it now.
Right.
And then that's it.
They're going to get paid back either way. In other
They're
words,
going to
right?
get
I
paid
mean,
back either way.
Right.
So that's the same as the loan advance companies, although you don't have all these extra
Right.
fees.
But yeah,
and
that's one of the arguments we hear. Well, it's not recourse. You don't really have to pay us back, but they're going to get paid back. They always get paid back because they've got a direct line in your bank account, right?
Well, I mean, that's the same as a loan company. The only difference
Right.
is that you have the advantage of choosing how you want to do it, because it's versus wages that I've already earned versus you give me $100 right now and I'm going to charge you this APR that everybody's been talking about, or this interest or percentage, or you have to have a subscription, or et cetera, et cetera.
Okay. Any other questions for Tanisha? Anyone? This has been very helpful, Tanisha. I appreciate you, you're being patient today with us as we
No, I
work for our list.
appreciate you being patient with me as well. And I hope that the committee, take it into account. We've talked about this and that, but the numbers, should really signify that, EPA is, again, is distinctive, even though it's maybe have some of the same characteristics. It's in its own category, and it should remain that. If you want to apply restrictions, regulations, it should still be defined under its own category and have that opportunity to not tie me down to a loan box, because that just causes me more than having the opportunity to have that choice.
Okay,
And if
thank
you take away that choice.
I did have one other question. I just realized. I was curious how you heard about this whole issue today. Did you read about it? Did you hear about it directly from Earnin?
Yeah, I did, because what happened is that I started using Earnin, I want to say around June, and it was a huge advantage to me because I get paid bi-weekly. I'm a single mother. I've had a lot of challenges that came up in between the time, and it was very helpful. And when January 1st came out, I got a notification that due to Connecticut regulations, the service is no longer available in Connecticut. And it was like I was broken because you take away the opportunity for me to have a choice and decide what it is that I want to do with money that I've already earned. So how is that your responsibility? And a lot of the people that are here today, people that are speaking either against or for, you're not the ones that are benefiting from directly using the service. That's me. That's people like me. And I was just heartbroken because, again, all of the other, if I know I want to get a cash advance and a loan and go through all those other things, I can. But that's what's going to drive me more into deficiency and debt, into those type of things. Earning has just been a big help because, again, it's my money, and I can get it now. That JG Wentworth, it's my money and I want it now. We should have the choice to be able to decide to do that. And EWA and cash advantages and loans, it's two totally distinctive different things. And I think that there should be a way to regulate and decide how it can all benefit everybody, and being distinctive in their classifications.
Thanks, Tanisha. Before I let you go, Representative Delnicki here just thought of a question he'd like to ask.
Thank you.
Thank you, Mr. Chair. You made a comment that really touched me. You stated that when you heard that it was no longer in play, that you were heartbroken. Can you expand on that?
Yeah, I was, because, again, I'm a single mother. I got used to being able to have that advantages. I was going through a lot of things, like, my car broke down, my son got in an accident, I had health issues, and it was a lot just to be able to say, okay, you know what? Because, again, we've came out of this pandemic with a lot of people that didn't have jobs, part-time jobs. The economy, with everything, the cost of living being so high, I get paid bi-weekly. And when I get paid on a bi-weekly schedule, you got your rent on the first, car insurance, you got other bills that you have to sit up and figure out how you're going to manage that in a whole 2 weeks. And if you ever come across a situation where you've been at a gas station, I've needed food, I've needed these things, I can depend on, I was dependent on being able to say, you know what, I don't have to wait the next 2 weeks till I get paid. I can take $100, $150, and or either plan ahead, or if I had an emergency where I needed it right now. And that's so much distinctive to me than having to go through all these other apps, because I've tried a lot of apps and I can name them if you want. I've been on Clover, I've had Dave, I've had Power is no longer there. They're EWA2. They're no longer, I got the same message that I got with earning. But I've used Chime. I have a Chime checking savings. And so, again, when you get into the bottom line where you want people to have, number one, the option to choose, okay, and to say that we don't have to say we're going to loan you money. We're going to look at what you've earned already, and you're going to get that. You're going to get that as a service, because the more people that's using the service, I mean, again, they have their little ATM fees. So there are ways to get around the overall cost of not having it be dependent on me, where I have to sit up here and feel like I'm in a bond, and I have to decide whether I'm going to go get a cash day loan, payday loan, or provide one of these other services, that at although that first transaction, it might seem free, but after that, if you want to keep on using it, you have a monthly subscription. You have to go through all of these other loops and trials and tribulations, to where it's like, when you're in an emergency and you're in a time of need, you don't want to think about those things. You want to think about, okay, I've worked for the last 2 weeks, 4 days, 3 days, or whatever, and I've earned this amount, and I know that I have the option to access that if I have an emergency or a need, without there being any strings attached, any extra things that you don't have to go through. It's either going to be, for me with earning, it was either I get $100 and I pay that fee and that's it. Or if I want to get it in 1 or 2 days, if I know I can wait, then I don't pay anything. It
Yeah.
doesn't matter whether if my employer signed up or paying cost or not, or it doesn't matter about any of that. And so that's the difference to me, with the distinction between earned wage access and loan companies. And it's just different. It's not the same. And it shouldn't be classified as the same.
I appreciate you sharing that story with us. Thank you, Mr. Chair.
Thank
No,
you,
you're very
Representative.
welcome.
And thank you, Tanisha, for sharing your experience. Certainly knowledgeable on this issue, probably
I
more so
appreciate it.
than
I was
all
so
of us here.
nervous.
So it's good to hear your perspective.
Thank you.
Okay, thanks. Next on my list is Farah Remtula from Bridget.
Yes.
We're
The next
we're getting towards the end of our list here. So the next person, so Farah, why don't you go ahead?
So I'm at that age where I can't look at you and read at the same time. So they're going up. Okay. First of all, thank you so much, Chair Doucette, honorable members of the Banking Committee, for allowing me to speak. On behalf of Bridget, my name's Farah Remtula. I'm the COO. Bridget's a financial health app. We're focused on helping the 150 million plus Americans in this country who live paycheck to paycheck, build their financial wellness, and help alleviate short-term financial stress. We do that with a suite of products. Earned wage access being one of them, but also with credit monitoring, credit building, identity theft protection of up to $1 million, and budgeting and savings tools. We offer this as part of a subscription, a flat $10 a month that customers pay to us. And they also have the option, fully optional, of paying an additional 99 cents if they choose to have access to their wages expedited. This is not a condition for getting that access. I just want to be clear about that. Customers can use the product as many times as they want within that month without any additional charges. So it truly is a flat fee that's entirely transparent. EWA is a valuable financial tool. It allows access to a portion of earned wages. And I think that's a really important distinction from a loan or a traditional payday product. The flexibility helps manage unexpected expenses. We've heard that. But quite frankly, what we see in our customer data is it also helps to cover essentials. I'm talking groceries, I'm talking medical bills, I'm talking gas in your car. And it's products like ours that help our customers do that without having to revert to more predatory options. Our model is direct to consumer, and it allows customers to independently subscribe without being dependent on their employer. Why is that important? Because your employer might not offer it, because you might, as we heard in the testimony, change employers and suddenly no longer have access to something that you're using. Another advantage is it allows you the convenience of setting up the payments as per when you think you can handle it, and also making that relationship private, just between you and us. So your employer doesn't even need to know about it. It's entirely confidential. I want to talk a little bit about the protections that are in place for consumers as part of EWA, and that is that our EWA product is no recourse. I know we've talked about that before, but let me explain what that could look like in reality. You could sign up for a product today, you could get an advance tomorrow, and then you could truly cancel the very next day, and we would have no option on reclaiming those funds. There is no recourse for us. As part of that, there would be no implications to your credit score. We don't look at credit scores. We don't report to credit bureaus. There would be no late fee. There would be no penalty. It's truly a non-recourse product. And I think that's important to emphasize. I also want to touch on something that I heard, which was that customers are not left better off. And I have to disagree on that, because when I look at the data with our customers, if I look at Bridget members 2 years ago and I look at them now, on average, they have on average about $247 additional in their bank accounts. Now, that might not sound like a lot to you, but for folks who have literally living paycheck to paycheck and on average less than $400, that is a lot. So thank you for your time. I see I'm at time. Our goal here is just to work together to include direct to consumer models within the legislation so that we don't rule people out of having access to this option.
Thank you. Two quick ones.
Yep.
I think probably specific to your model, as I understand it. You have a lot of other services that you offer. But the reason you're here today is because that's sort of all mixed together with this this other product, the EWA product.
Yes.
So again, if you separated them out, if what you were talking about was just all of the other suite of services, then you wouldn't be here today. And I guess my point is, could you do that in a way that you could quantify? Because I guess the part of the problem is I think I spoke to your CEO at some point previously, is that it's all kind of mixed together with the subscription fee.
Right.
So we can't really separate out, okay, what's the value of these services here? And it makes your job perhaps harder in trying to go ahead and calculate an APR. I mean, could you separate the two things out and in such a way that you could, adhere to our APR limits?
It would be, I think, would be really hard pressed to do so, because we actually do see customers utilizing the additional product. So we see customers using credit monitor. I mean, the reason we pay for these products to be able to offer them to our customers is because our customers use them and see value in them. And so how I would parse out what portion of the $10 people sign up for the access to the EWA, I couldn't tell you.
I understand.
What I will say is sometimes folks sign up for the suite of products, but it's really an insurance. It's a just in case I need this, I want to be able to access it.
And then my other question is about the non-recourse aspect. You said they could shut it down, but you have all the bank information, correct? So if you
I do. Yep, I do.
if you gave somebody $100 today and they tried to shut it off, you could get it back tomorrow, correct? Unless that person closed their bank account?
Oh, yeah, or the customer just went into the app and unlinked their bank account. And then
So once that bank account's unlinked, it's gone?
I can't access it anymore.
Interesting. Okay. Anyone else? Any other questions? No, I think that's it.
Thank you. very
Thank you.
much.
Okay, Ryan Naples.
Two of us, actually.
Okay.
Good afternoon, Chair.
Thank you for joining us. Thanks for your patience.
So I'm Ryan Naples. I serve as the Director of Public Policy at Daily Pay.
And I am Elise Hicks. I'm currently the Public Policy Manager for East Coast and Major Markets, but prior to this, I spent time in consumer advocacy as a consumer policy counsel and worked with a lot of the people that you've heard from.
So I want to say we're the largest employer integrated company in the country, and we've got in the state of Connecticut over 100,000 users, and that's been through partnerships with over 1,325 in-state businesses. So you have our written testimony. I want to highlight a couple points, but first I do want to go back and address a couple of things that were said like very, very early on in testimony. And I think part of what we've been going back and forth with the banking department on is whether or not verified pay that someone has already earned is future wages or not. And like, I think that's been a point of contention, because so we sign agreements with employers, and then we integrate with their payroll and time and attendance systems. And then our system updates 4 times a day. So people are not accessing or getting access to anything on our app unless they've earned it and we've verified it in the same way that a payroll company has. And so we have, it is an interesting argument, because FlexWage, which is the company we keep talking about, is unique in this industry. So unique that we don't believe they have any customers. So in the state of California, every company had to have an MOU and share data on a quarterly basis. FlexWage does not have any California users, so they do not have an MOU. So because no employer really has a pot of money lying around to hand to a third-party provider. A colleague of mine did talk about how, like, what's really the difference, because it is still, it's a combination of EWA company money and bank funded money. And when really, I think the more important thing is about the fee cap, let's be honest, right? And I do think it is unique that, and not surprising, because FlexWage has so few customers, they do not have the capacity to offer a free option. Our service does. Most of these companies do. The laws that we actually have been supportive of in other states codify a requirement of free options, codify the requirement of credit and visibility, which we've instructed Phil's not, oh, he's still here. Okay. Like every company that's a member of his organization is 100% in favor of credit and visibility as a codification. I think what he was saying and what we were talking about a lot before was that, we do not sell to customers, individual employees. We sell to the corporate compliance attorneys at companies as large as Target. We try very hard, including with our employers like United Health, to get them to cover the fee. They do not. Oh no. Anyway, we have some changes we would propose, like instead of a higher fee cap, instead of a monthly fee cap, a lower per transaction fee cap. We wanted to talk about the paycheck cap, and then the wage deduction.
Let me ask you about that then.
Yeah.
While you're here,
Yeah.
and your 3 minutes are up. You said your suggestions on how to make this bill better would be, you said adjusting the fee cap. In
Yeah.
what way?
To $3.50 per transaction, as opposed to, any monthly fee cap. And we think that that's a rate that everyone already, to be honest, is offering. And so I do think it's not advisable to make it as high as $5, because I don't believe anyone in the market really is charging $5 that we are aware of. But if you make that the cap, it'll go up. And
Is there a maximum number of times that you can use, you can get an advance on your app?
So
pay
there is
period?
there's a per day amount. I believe it's like $1,000, but I think that our average is around like the industry average.
But
which is
no,
like
the
$150.
number of transactions.
Like the number of times we can
Once
per
a day?
Oh, I don't believe we have anyone doing it more than once a day. I know it's called daily pay.
Right.
We've never seen anyone. I mean,
Okay.
it would be
But
around.
theoretically, there's no cap on it. So you could do
There's
it,
no
you could
cap
do
on it, right.
daily. You could do it
Part of
30 times a month.
Right. Part of the reason why there's no cap on it is because people use this when they need it, as opposed to using it for fun. Like we're not in a vacuum, right? So we're the largest. We've done the most research. So we have over 78% of people are using us, and before that they paid a bill late or not at all. 60% of people were, or 40% of people were overdrawing their bank accounts. We don't solve for income insufficiency. We solve for a frequency of pay problem, and that does save people money. Our estimates was that we save people $600 per month. And so that's if they were frequent overdrafters. So that's really what we're talking about in terms of like the paycheck access. Actually, Elisa, I was hoping you could talk about that.
Yeah, well, what I would like to add is going back to the representative's question about what is the solution if we take this away. There was no solution that came to be in that conversation. This is the part that I really care about as a still consumer advocate. We don't want to take this away and drive people back into overdraft or payday lending. So just going into the paycheck the 50% cap on the paycheck, we do believe that having that cap would, again, drive people back into overdraft or payment.
And I also want to add, we're operating without a paid transfer option. So we already had 2 free options. We're large enough to continue that, but I think we didn't become a lender for like a very specific reason, because our employers will not want to become licensed lenders as well. And so we do believe that like this isn't a like will we operate for the first time in the state. It is like we will be permanently having to leave the state most likely if there is a credit designation. I think that that's like a real, like, because again, this is not a conversation in a vacuum. We've got half the industry that's already not operating, the direct consumer providers, and we're operating a partial in partial service. I will say the real change we've seen also just in the last month are like 30% of increased consumer complaints about a lack of access. So people are looking for the ability to transfer to their bank accounts instantly. We do have the debit card the same way that PayActive does. It's also the same method that Walmart has, where you have to send to your direct deposit to their app. And so while we've seen an increase in that, it's also led to an increase in people just accessing more at once, because they know that they're going to need to wait for the money to come to them. So it is, I think a fee cap makes sense. I also do want to say, when we talk about our opposition to becoming licensed as lenders, I do think that we're talking about the APR rate. We're not talking about like everything else that is required of a lender, because we do the inverse of that, which is already better for people. So like we really are, and I hate to speak for the industry, they're all gonna be like, stop. But like that really is what we're talking about. It's like, give us everything that a lender has to adhere to. In fact, the inverse is also true. Like you would want to see lenders behave the way that we are requiring EWA providers to behave, where it's credit invisibility and there's no recourse. We do hear often that like they don't believe that people are coming to us and asking us to sell us their debt, that the non-recourse issue is really almost like a fantasy. Like you really can just shut off the service, and people do constantly come to us to ask if they will sell us if we will sell them our debt. So like it is like not a like it is not like an imagined consumer benefit, the non-recourse. That's a lot. Sorry.
Thank you.
Yeah.
Any other questions for these guys? No? All right.
All right. We appreciate
We'll let you go.
the
Thank
bill
you.
and the work.
Appreciate
Thank
your
you.
time and your patience. All right, we're moving along. Next, we have Lauren Saunders on our list, who is online. Hi, Lauren.
Hello, thank you very much. I'm Lauren Saunders, Associate Director of the National Consumer Law Center, a national nonprofit organization that works for economic justice for low-income and vulnerable consumers. HB 5140 has positive attributes, but we must respectfully oppose the bill because current Connecticut law is the consumer protection gold standard for regulation of fintech cash advances and should not be weakened to authorize additional fees on low-paid workers. I appreciate that the bill rejects arguments that earned wage advances are not loans. Costs could exceed 300% APR, loans trigger frequent reborrowing, on average 36 times a year, and lenders successfully collect 97% of the time. HB 5140 declines to provide a loophole for direct-to-consumer fintech payday lenders that debit bank accounts. These loans will continue to be subject to Connecticut's usury laws, and lenders cannot use so-called tips or donations to evade those limits. And unlike the ALEC model bill, which is a thinly veiled attempt to eliminate all interest rate limits, this bill puts a cap on costs, including an overall monthly cost cap, which is important to prevent fees that seem small in isolation from snowballing. Nonetheless, we see no reason to weaken Connecticut law, which currently meets our top recommendation, which is to apply the same cost limits to earned wage advances as to other loans. Indeed, some of the new technology outlined in today's testimony shows how payday lenders and others can mimic earned wage advances. Treating all loans consistently is especially important in states like Connecticut that have strong interest rate limits. Our secondary recommendations were designed for states that have weaker small dollar loan laws that allow payday lending and do not protect consumers. The bill's proposed expedite fee of $5 up to $10 a month is too high and is really merely disguised interest. The cost of sending money instantly through the clearinghouse's RTP network, for example, is only 4.5 cents. And I understand other services are in that range. But the typical earned wage advance usage pattern would result in $120 a year in fees under the bill. The providers testifying today, some of them have emphasized the benefits for employers, and employers can cover the cost as a benefit, as some already do, and I strongly believe that more will if they can't push the costs onto workers. These loans are promoted in the fast food, retail, and healthcare industries where workers receive low wages and they need every penny. Therefore, we respectfully oppose HB 5140. Thank you. I would be happy to answer any questions. I've spent a lot of time studying this industry and happy to answer any questions.
Thank you, Lauren. So you are opposing this bill, but fair to say you're opposing it for completely different reasons than most of the other speakers we heard from today.
Right.
Okay. That's an interesting place as a legislator to be. I'll just leave it at that. I guess in terms of fees, I mean, what would be your position on, say, ATM fees or expedited transfer fees when they're on Venmo or some other app as opposed to on one of these apps?
Well, I mean, you know, an ATM fee is an ATM fee. Most people don't pay those fees. They, you know, mostly go to their own bank or a provider in their network. But we're talking about enforcing a law that Connecticut has that regulates the cost of loans, or 36%. Now, we have to remember that the reason the payday lending industry exists in a lot of states, thankfully not in Connecticut, is because lenders went to legislatures decades ago and said, we're not a loan. Our fees are not interest. We're just a deferred check. We're just a deferred check cashing fee. So you can come up with clever analogies, but your employer is not your bank. They are not holding your money for you. In fact, we've heard that, you know, the employers don't even really have that money often until payday. It's not your money until payday. So it's really a false analogy. It's just a clever way of trying to avoid the truth that these are loans and they have, you know, they have interest, whatever you call it.
Yeah, I agree with most of what you said there. I guess the part I'm struggling with is you said $10 a month is excessive and that most people don't pay ATM fees. I think I probably pay $10 in ATM fees a month. I think a lot of people probably do. So I guess I struggle with that characterization. I don't think that reflects reality necessarily, but I agree with a lot of the other points that you made. Anyone else have any questions? Okay. So with that, thank you, Lauren. Appreciate you being with us today.
Thank you.
Pete Eisberg is online. Welcome, Pete.
Thank you, Mr. Chairman, members of the committee. Appreciate the opportunity to provide input on this important measure. Again, my name is Pete Eisberg. I serve as president of the National Payroll Reporting Consortium, which is a nonprofit trade association representing the nation's largest payroll service providers who manage payroll processing for about half of the U.S. workforce. We thank the sponsor and committee members for their efforts to clarify the treatment of EWA, which are increasingly sought as a helpful benefit to employees. So one concern we have is that the bill does refer even to employer-integrated EWA services as a loan. We view it as it really is an administrative feature associated with payroll that simply permits workers to access part of their earnings prior to payday. Such amounts are automatically recovered with the next scheduled payday, which is so efficient that for the most part, these services can be offered free of charge, which is pretty astounding. EWA services represent the best alternative for consumers who face unexpected expenses prior to the next payday. And it's proven valuable to employers as well in terms of improved employee financial wellness and reduced employee turnover. We did have two suggestions to the bill. One's somewhat technical. One is that the bill should clarify that payroll service providers, whose role is to simply facilitate EWA services by verifying available wages for the EWA providers, should not be required to register as an EWA service provider. Payroll firms are not in the business of providing EWA services. Any registration or other related obligations would probably result in payroll firms declining to facilitate EWA services, which would effectively make employer-integrated EWA services unavailable in Connecticut. The California Department of Financial Protection and Innovation issued regulations on EWA services with an express exemption for payroll firms that serve this limited facilitation role. Their language is in our written testimony, so we would suggest that. The only other point is that we're a little concerned about the fee cap for expedited employer-integrated EWA services. These, employer-integrated EWA providers generally offer cost-free options, but per transaction fees such as $2 to $5 may apply if the requester needs funds immediately. If they are not able to charge for same-day transactions, those just won't be available in Connecticut, and optimally consumers would be able to choose to pay a modest voluntary fee to avoid far worse outcomes, such as a $35 bank insufficient fees, funds transfer fees, or loss of a job for lack of transportation funds. So other than that, I would ask you to look at the written testimony, and happy to answer any questions. Thank you.
Thank you, Pete, and thank you for the very specific and constructive comments. Any questions for Pete? Seeing none, I appreciate you being with us today.
Thank you.
Okay, and then the last person I have on my list today is Simone DeSantos, who is with us today. It says remote on my list, but happy to see you here, Simone. And
Here in the flesh.
thank you very much
Pleasure
for
of being the
patiently
cleanup
waiting.
girl. So I hope everyone's still awake. Good afternoon, Chair Doucette, Representative Delnicki, and members of the Banking Committee. My name is Simone DeSantos. I'm the Deputy General Counsel for EarnIn, a leading provider of earned wage access services direct to consumers. I'm testifying in opposition to HB 5140 because it leaves behind tens of thousands of Connecticut employees who choose EWA services on the open market. So we're talking about Connecticut state employees, we're talking about nurses, teachers, and small business employees. Before I get into my prepared remarks, there are a number of things that have been said throughout the afternoon that I want to address very briefly. Representative Doucette, you asked about the tip jar. The tip jar is the mechanism by which EarnIn customers can take their own money and set aside in a jar for themselves, so it acts as savings. And then when they're ready, they can withdraw that money and we send it directly to their bank account. So that's what the tip jar is. So we call it tip yourself. So you have the option to tip us, you have the option to tip yourself as you're engaging in financial transactions. So that's what that is. Another important thing of note is that customers have the ability to, at any moment, reschedule in advance. If they don't want to pay it back, they can reschedule it to a later date, or they can simply not pay it back. And that is a fact. And there was I think CRL said that it's not a big deal that there's no debt collection. It's not a big deal that we don't do credit reporting. It is a really big deal to a lot of people that used EWA because they've gotten into traps of having things negatively reported, which diminishes their financial ability to plan for themselves. One other note is that I thought was interesting with CRL's testimony is when they were asked, well, what are the solutions? They carefully dodged the answer. The answer is because the solutions that exist aside from EWA are extremely costly. They're overdrafts, they're other high cost loans. And that is the solution. And the reality is that there are no other solutions that are consumer friendly to people who are facing a liquidity crunch. This is very different than payday lending. Payday lending has a stated interest rate. There is an interest rate upfront. There is an APR. That is a fact. If you don't pay, they will come after you. They will call you, they will email you, they will sell your debt, there will be debt collection, they will report to credit. The loans roll over. So this is distinctly different than payday lending. The loans, if you want to call them loans, doesn't really matter what you call them, honestly. Don't roll over. You pay, you don't pay. It's the end of the story.
Okay. So that, yeah, that's your 3 minutes, but you did say that you submitted written testimony.
I did,
which
yeah.
I appreciate. I do have a question, and picking up on where you left off, you said it doesn't matter if you call it loans or not loans. I mean, we've heard testimony today and
Right.
from many others who said, please, no, it's not a loan. So could you clarify on that? Is this a loan? And if it's
This
not
is-
a loan, then what is it?
This question of loan, I think under the Connecticut law, as loans are regulated under the Small Loan Act, it is not a loan. When we talk about the term loan colloquially, there are loans that should be regulated and loans that should not be regulated. If my friend asks me, hey, can I borrow $10? And I give him $10, is that a loan? Yes, it's a loan. I gave you $10. You didn't have it. Should that loan be regulated under the Connecticut Small Loans Act? No, it shouldn't. And so when I said, it doesn't matter what you call it, we're getting into a question of semantics. Certainly, we argue that under the Small Loan Act, it should not be classified as a loan because the law considers loans. When they took us back to the banking department took us back to 1920 when the law was written. They're specifically talking about money that you give to someone else where there's an interest rate charged and you must repay the funds. There's the expectation that if you don't repay the funds, we'll come after you for that money. That's the loan that they're talking about. EWA doesn't fit into that.
Yeah, but the scenario that you just gave us where your friend's giving you $10, I mean, we have all kinds of exceptions for people who are not in the business of lending or who give less than 5 loans a year or whatever it may be. But you admitted it was a loan. So what you're talking about with direct to consumer and earn-in is, let's stipulate it's a loan, but you're saying it shouldn't be regulated. Yet you have all of these other features, including transaction fees, tips, tip jar, which I just learned about and have actually more questions on now. So why should earn-in be treated like my friend who just gave me $10? Why is it something that shouldn't be regulated?
Because I should be clear that earn-in is in favor of regulation. We believe that there should be a license or registration regime with guardrails put into place that preserve the voluntary nature of EWA. That is, you don't have to pay a fee if you don't want to pay a fee. You don't have to tip if you don't want to tip. You are able to cancel the transaction or the repayment of the transaction whenever you want. So I want to be clear that we do believe in regulation that makes sense for what the product is. But in terms of the overall question of the semantics of loan, the purpose of the Loan Act is to protect against predatory lenders, people who go after unsuspecting consumers. That is not this. Just as me giving $10 to my buddy is also not that.
Tip jar. Again, I have more questions now. So the tip jar, the money is put aside by the consumer.
Yes.
But yet there may or may not be an expectation that they're going to get it back. If they don't request it back, well, okay, hold on. So I'm sorry, I see your colleague shaking his head. So let me back up. So the tip jar, the money's put in the tip jar. It's no longer in the control or possession of the consumer. Is that correct? It
No,
sounds like you said that it's sort of put aside.
They put it aside. So it's just like if you are in your, let's say Bank of America app and you transfer $10 to the savings account. When you decide, okay, I want to transfer the $10, I want to withdraw it, you go into your app and you withdraw it. So it's the same.
So wait, are you guys a bank?
No, we're
With
not
that
a bank.
respect?
I'm saying it's something that is sponsored by our bank partner, and we are the facilitator of them moving the money into and out of a bank account, of a savings account.
So what happens if that that consumer doesn't request it back?
Then it follows the unclaimed property laws of the relevant state. Just as any money would if you had it in an account and you didn't access it and time passed, your money would always be there.
Okay. Very creative.
Ben, my colleague. Ben
Can I
answered.
just add, so this is just a normal savings account?
Sir, you weren't signed up to testify, but
Yeah, it's a normal savings account. I just wanted to clarify it because of the testimony that you heard.
Delnicky.
Thank you, Mr. Chair. And you made a comment during the discussion on the tip jar. Is it a savings account by any other name?
It is a non-interest bearing savings account. Yes.
And does it accrue interest?
No, it's a non-interest bearing savings account.
So I'm just trying to nuance that as to what it actually is, what the tip jar actually is. If it's technically not a savings account per se?
It's a non-interest bearing savings account. So you can-
Okay.
So you can save money,
non-interest
and I, like in my app, when I use it, let's say you want to set money aside for, like a field trip, like your kid's field trip or something. And it's coming up in 2 weeks. So you can put your $25 in there, set aside so that you
Okay.
preserve that money so that you're able to make that, send the $25. So it's a way to save money and encourage savings. It's one of the many products that we have that are built into the app to help people build financial momentum and plan for their future.
And you made the comment about moving the date to repay or not pay it back.
Correct.
So somebody could actually literally walk away,
Yes.
and then you would deny them ever being able to utilize your service again, I would guess,
Until they pay it back.
or until they pay
And
it
what's
back.
interesting is that the class action settlement that was mentioned, that is from 2021. And with the settlement, the plaintiffs were suing, and as a part of the settlement, sued to get back onto the app because they were not able to use it because they hadn't paid back funds. So it's interesting to me that if it's that bad, why are the plaintiffs in the class action suing to be able to use the app again? And I should note that that settlement preceded EarnIn's current practices. It was about conduct that happened from 2015 to 2020, and was settled only in the wake of what was happening with COVID. The company wasn't in a position to defend itself.
So
So that's what happened.
who initiated the class action lawsuit?
A firm that specializes in class action found plaintiffs that found EarnIn users.
And what was the actual judgment on the class action lawsuit monetarily?
I don't know how much of it is confidential, but I'd be happy to get you that information once I
I appreciate that.
find out the details.
Thank you, Mr. Chair.
Just following up on that, then there was a separate FTC action against EarnIn. Is that correct?
No, there's no FTC action against EarnIn.
Okay, there was not a regulatory action that arose out of that. I thought that's what was being alluded to initially.
Yeah, but I will note that following that class action, the Connecticut Banking Department then initiated inquiries into EarnIn in 2021 and determined that we did not need to be licensed. So it was interesting for us as a company to now, here we are in 2024, and all of a sudden we're being told that, oh, there needs to be a license.
Hold on. So again, the testimony that we heard, and I'm referencing the written testimony, was that EarnIn was recently ordered to pay 18 million in refunds to resolve an enforcement action filed against it by the FTC for unfair and deceptive practices. Is that not accurate?
No.
There's a link in here.
EarnIn and the FTC.
That's testimony that was submitted by, link is not live, but okay. Okay, any other questions? Anyone going once, going twice? Okay.
Thank you.
Thank you. Thank you for joining us today. Okay, so that brings us to the end of our list. I don't believe I skipped over anyone who isn't here or online. So with that, I'll thank you once again for joining us today and appreciate everyone's patience. And we're going to close the public hearing. Thank you.